All right, thank you very much, everyone, as we begin to make our way back into the room and take your seats. How about a round of applause for the service staff taking care of us during lunch? Thank you very much. If you're keeping close tabs on the program in front of you, just to know we're going to kind of shovel a couple things and bounce down, so you'll have to bear with me. A reminder, again, to scan the QR code to sign in and out of this panel discussion if you're looking for that credit as well. And I also want to commend all of you if you had a chance to stop by and fill any of those bags. We did all 250 during the lunch break, so thank you very much. You've made an impact for 250 youngsters who will utilize that kit in a time of great need. At this time, our panel conversation is going to turn to the topic of climate risk compliance and technical resilience. This discussion will focus around regulatory expectations, financial disclosures, and risk modeling. Moderating this discussion is Jeff Johnston, the Chief of Regulatory Affairs at the National Association of Insurance Commissioners. Welcome to the stage, Jeff Johnston. And a warm welcome to the panelists for this discussion as well. Thank you all.
Connor, I appreciate the booming introduction. I should tell you that I'm from Kansas City and an avid Kansas City Chiefs fan. That may change the introduction.
The rest of the room.
I was just trying to set the mood for this panel, but as Connor said, my name is Jeff Johnston. I'm the Chief Regulatory Affairs Officer at the National Association of Insurance Commissioners, again, based in Kansas City. Much of my responsibility centers on managing the subject matter experts at the NAIC that support the committee system. So relevant to this discussion is the Climate and Resilience Task Force that still sits at the executive committee level, as well as my colleagues in CIPR, the Center for Insurance Research and Policy, the CAT Modeling Center of Excellence. So from my standpoint, that's the perspective that I'll bring to this discussion. Before I introduce the panelists, as Connor mentioned, the elements, if you will, of this panel discussion revolve around regulatory expectations, financial disclosures, the climate risk disclosures, and risk modeling. So we're going to explore each of those different areas. I think our mission for the next 55 minutes is, I think there are 4 objectives that we have for this panel. We want to explore how the insurance industry is doing with its disclosures on climate risk and managing climate-related exposures. That's our first objective. Second objective is to hear how regulators are thinking about the climate risk disclosures and their assessment in terms of how companies are doing with their risk assessments. The third objective is to hear about advances in the CAT modeling space and the current uses, not only by insurance companies, but others, and the perspective, I should say, from the regulatory community. And bringing it home, Insuring the Future, we want to have a discussion on looking forward in terms of the future, where opportunities for improvements might lie in the area of these disclosures, the industry's assessment work, and CAT modelers. We do have the opportunity to take audience questions, and I've been schooled on the iPad that's right here. So as we progress throughout the next 45, 50 minutes, please submit your questions. I'll pick those up as we speak. In terms of our panelists, to my left is Beth Dwyer, who is the director of the Rhode Island Division of Business Regulation, and within that, if you look at her bio, that includes all kinds of things. Certainly relevant here is the insurance, banking, and securities. Beth is also one of the NAIC's officers. Again, one of my bosses that I typically find in one of these rooms. Next to Beth is Jaclyn Medicci Bruneau, if I landed that correctly. Jaclyn is with Ceres, which I'm sure is a familiar organization to most people in this room, advocating on behalf of companies, the markets, public policymakers in the area of climate risk disclosures. To Jaclyn's left is Jeff Waters. Jeff is with Moody's Analytics. He is one of our technical experts on this panel. He is in the product management space at Moody's Analytics in terms of building CAT models. And you look at some of his credentials, he's well certified in any number of related spaces, including catastrophic risk management. And at the very end is Dr. Julia Borman, who is with Verisk, and likewise, Julia is our technical expert on this panel. She does a lot of work where we have intersections with the regulatory community, the insurance industry, and others. So please welcome the panelists while I pick up my papers. So to kick things off, I'd like to turn to Director Beth Dwyer and ask her to take a few minutes in terms of setting the table for us around climate risk disclosures, a little bit of the history now that we've got, I think, 15 years of experience that have developed in the area of climate risk disclosure. So, Beth?
Yeah. So thank you very much, Jeff. 15 years in disclosures, but when I started at the Rhode Island Department 25 years ago, this was an area of discussion. I mean, insurers were the first people out there, obviously. They're the people who take the risks. So I remember 25 years ago going to conferences where they discussed, what would happen, if the 1938 hurricane that affected New York and Rhode Island were recreated today with the current population and the disaster that would be. But about 15 years ago, California was way out ahead of everybody else, and they were requiring climate disclosure from carriers writing in California. I believe there were 8 questions. And that went on for quite some time until other states indicated they were also interested. And the collective discussion was, well, how can we make this more relevant, the disclosures? And we settled on going with the TCFD format. Used by a lot of different industries, used by banking, securities, everything else, just to bring it all together and have something that the questions were the same, essentially. That started about 3 years ago with 20-something states. It's now, I think, at 25, and it is all the insurers licensed in your state, so it makes up 85% of the premium volume. So we've been getting that information for a couple years now. Ceres does kind of an audit and a report on it. I think Jaclyn can tell us more, but I think it gets a little bit better every year because the more you do something, the better you get at it. But we've also made a number of other statements at the NAIC about these issues. So the most important is the climate working group, which is at the executive committee level. What that means is it reports directly to the executive committee, normally an EX task force, and Jeff can correct me if he disagrees, but is something that is of the moment to the commissioners. It's an important issue at that time. It's something that the commissioners are really focusing on, and this is an EX task force. It has a bipartisan leadership, so Ricardo Lara of California is the chair. Tim Temple from Louisiana, I believe. It used to be, oh my goodness, I'm forgetting who. Director Lori Wing-Hire from Alaska is the vice chair. So we're trying to keep this as bipartisan as possible, as non-political as possible, while still addressing the risks that are really facing insurers. So a few of the other things, I had to write them all down because there's so many of them. that we're doing is, the TCFD, of course, every year, each insurer writing in your jurisdiction reports that. We also expect to see in your ORSA an address on how you're addressing this risk, especially, honestly, for a P&C company. I can't imagine that if I saw an ORSA without a discussion of the risk, I think I would be concerned that the company wasn't really understanding all their risks. We've also updated our handbooks, both the examiner and the analysis handbook, to address climate risk, just like any other risk. Insurers should be addressing all of these risks. We've also made RBC CAT changes, so there's a CAT charge coming up on our RBC. 12/31/24, there's going to be a wildfire charge. There's also, within the RBC framework, a consideration of severe convective storms. And there's RCAT reporting. So that is in the interrogatories to the annual statement, and I believe that starts, is it this year or next year?
It started with year-end 2024 reporting.
Oh, okay, so it just happened.
Yes.
And again, we hope every year it gets a little better, just like the TCFD. So, I mean, from my perspective, for my domestic companies, our analysts and examiners are looking at climate risk as an important risk of the company and making sure that the company is addressing that risk appropriately like any other risk. And I'm sure as time goes on, the NAIC will accept all other great ideas and consider whether or not that reporting would assist regulators and companies.
So Director Dwyer, with those tools and the activities on the examination front and the analysis, would you characterize that type of approach compliance-oriented, or is it more those tools are there to facilitate that discussion with company management on how they're approaching and assessing and managing climate risk exposure?
Yeah, it's definitely the latter. I mean, we've switched to a risk-focused approach many years ago, and what we're really interested in is, does the company understand the risk? Is the company addressing the risk? Of course, you need to comply if it's a compliance issue, but that's not the point. The point is, does the company understand what's happening with the company and with the climate risks that are out there and how they're addressing it?
Okay, very good. Director Dwyer mentioned the risk-based capital interrogatory, and as I said, that's new as of year-end 2024, and it's expected on the part of the companies, and I think we saw about 80% participation in that, meaning there are a number of companies that, for whatever reason, it could have been domiciliary discretion, did not complete that part of the risk-based capital interrogatory, but the move is to have companies communicate in a more structured way to the regulators, more forward-looking or scenario analysis of their climate risk exposures, particularly in the area of hurricanes and wildfires. That information is for information only. There's no risk-based capital factor yet associated with that. That will be in place for the next 2 years, at which time the NAIC and the financial regulatory community will reassess its utility, whether there need to be any changes, in fact, whether it continues. The other interesting twist I'll put on Director Dwyer's comments about the early days at the NAIC, because the NAIC is sometimes often referred to as no action is contemplated. And that has not been the case in this space. I did a little bit of homework before this session, and we had established an executive committee level working group back in 2005. I think this was just on the heels of Hurricane Katrina, and that working group was named Climate Change and Global Warming Working Group. So take a minute and let that sink in. Obviously, it had its own controversies in the day. I think we had the global financial crisis that kind of interrupted a little bit of that work before we got to the climate disclosures. But anyway, I thought that would be an interesting factoid for the audience. So thank you, Director
I
Dwyer.
forgot about that, and I was actually on the working group.
You're on the
so,
working
yeah.
group. And by the way, yeah, the Connecticut Insurance Department is at the forefront of that initial executive level working group. So let me turn to Jaclyn now with Ceres. And it's well established your organization advocating on this front has done a tremendous amount of work. And I know there's been a recent report released by Ceres looking at evaluating the progress. And I forget the name of it. I think is measurement gaps. And I think there was a particular area focused. But Jaclyn, from your perspective and your organization, is the industry getting close? Can we say mission accomplished yet? Or am I being rhetorical in that question?
Well, Jeff, I think it's tempting hubris to ever stand somewhere and declare mission accomplished. But just to back up and give a little bit more context, Ceres was working directly with the NAIC in the lead up to the adoption of the TCFD framework for the Climate Risk Disclosure Survey in 2022. And the discussion at that time was, well, great, we're going to have this survey, we're going to have this information, what are we going to do with it? And that's when Ceres stepped up and said, we'd be happy to run the analysis. So every year since the adoption, through reporting year 2022, actually, we've done this analysis in partnership with the California Department of Insurance, the state that acts as the main aggregator for all the surveys, and Manifest Climate, a software learning company. And what we've done is we've applied machine learning analysis to the thousands of pages submitted every year for the survey. So in that first year, just to provide some benchmarking, in that first year of the TCFD framework, it was actually 15 states,
Sorry.
plus DC.
You know the states better.
That's all right. 15 states plus DC in that first year of TCFD reporting, capturing about 80% of the US insurance marketplace, over 400 insurance groups. In the most recent round of reporting that we did analysis on, which would be for data year 2023, actually, we had 29 states participating, capturing 85% of the market, over 500 insured groups. So from a participation perspective, we've seen greater participation year over year with more states participating, more carriers being captured, and eventually we hope to capture closer to 100% with lowering the minimum direct written premium threshold, triggering participation. So what we've seen in the last year of reporting, and I say that because the most current year survey just closed in August, so we're actually beginning work on the next report already. But what we've seen is really good news. And for those of you not familiar with the TCFD framework, it's Task Force for Financial Related Climate Disclosures. And it comprises of 4 main pillars: risk management, strategy, governance, and metrics and targets. And within those 4 pillars are 11 recommendations, each of which asks a carrier, and these are open-ended questions, to describe or disclose how they're doing something particular to that pillar. So in this last year of reporting, we had 99% of carriers provide information across the risk management pillar. 97% provided information across strategy, 87% across governance. And these are all incremental improvements year over year, even adjusted for greater state and carrier participation. And that's fantastic. We're happy to see that. Progress is progress, and we don't want perfection to get in the way of progress. But as you mentioned, we also saw that for the 3rd year in a row, only 29% of responding carriers provided any information in the metrics and targets pillar. And in the metrics and targets pillar, what carriers are asked to do, it's 3 recommendations. They're asked to describe or disclose the measurements and metrics they use to assess their climate-related risks and opportunities, disclose their scope 1, 2, and 3 greenhouse gas emissions, and describe and disclose the targets they are setting to reach their climate-related goals. So only 29% year over year. I mean, we just really plateaued in that reporting area. So we did that deep dive companion report that you mentioned called the measurement gap that took a real qualitative analysis into the carriers that are providing information, what are they saying? So within that one, what we saw was that of the 45 carrier groups that provided information across all 3 recommendations, 87% included climate goals, but none of these groups had included absolute emissions targets. So what does this all mean? What am I saying here? All of this comes down to saying that the industry is doing fantastic in the first 3 pillars, and that's to be expected. Risk management is the bread and butter of the insurance industry. But when it comes to actual measurements and target setting, that's just really lagging, and it's due to a combination of factors. But that's why we put that report out to create resources, to pull out best practices, see what your peers are doing, identify why that seems to be a barrier. So all of that is a really long way of saying, mission accomplished, not quite yet. It's mission accomplished as far as we've answered the question of should there be disclosure, and now we've moved on to what does good disclosure look like, and how do we transform that into actionable strategies.
So a couple of follow-up questions. On the 29% plateau, when your organization evaluates those disclosures, are you going well beyond the insurance company's operation and footprint, meaning into its book of business and what that insurance company is doing, relative, say, in the underwriting process, looking at their clients, their insureds from a climate risk management standpoint?
So we do our scoring specifically off the information the carrier themselves provided. So we're looking for that kind of response, that they've integrated it across their business operations. And we've seen progress in those areas. In the first few years of reporting, we had health and life companies specifically say, we don't really see the materiality of climate risk to our business operations. As soon as we do, we'll include that in future year surveys. And that is starting to be more and more integrated. That materiality is being recognized and adjusted within those survey reports. But the 29% in the metrics and targets, so when I say 29%, that means the other 71% of carriers responding and submitting a survey, they're not providing any information at all. Those are blank questions.
Okay. My second follow-up question has to do with the flip side. Disclosures are one thing. If for those of you that have worked on the financial reporting side, it's a compliance exercise in many respects. Do you have any insights into how that's being internalized from an operational standpoint, an executive point of view, in terms of what's actually happening substantively within the company's operations?
Yes, so obviously, the property and casualty companies are kind of ahead of the game for other lines of business as far as that goes. But I think it's morphed into more than just a regulatory response, right? It's a requirement, so we do it. And we saw that more in the first year with, a lot of the questions left blank. But we're seeing more questions answered year over year and more robust responses. So increasingly sophisticated governance structures, better and better use of scenario analysis and those tools. Where we're lagging, though, really is that metric and target pillar, because you can have the first 3 pillars beautifully laid out, but if you don't have the measurements and the targets, then how can you turn that into meaningful action and move forward as a company? So instead of reacting to climate risks, how are you adapting and integrating it into your business operations and your plans to move forward?
Okay, all right. let me turn to Mr. Waters, Dr. Borman. Anything to add to this initial part of the conversation before we shift gears into modeling and technology?
I think one thing that's been hinted throughout the course of the conference so far is, when it comes to these disclosures, whether they're for compliance purposes or other kinds of reporting purposes, just the need and the opportunity to educate. And it could be educating from a modeling standpoint to a state DOI or a state regulator, or it could be educating from an insurance company standpoint to the actual consumer. I think in the former, one thing that you hinted at, Jeff, is the establishment of the Center of Excellence, of the COE. And that's something it's fairly new, it's getting off the ground, but like one of the pivotal cornerstones of that center is to provide more materials for state regulators to learn about catastrophe modeling, the frameworks, the ins and outs of these tools that are being used for these kinds of reporting purposes. So that's one thing that I feel like is going to really get a lot of momentum going forward in terms of helping a modeling company like Moody's understand what's clear, what's not clear when it comes to how we talk about CAT models, especially if they're being used down the line for RBC frameworks or some of the TCFD-based disclosures, and really promote that partnership, that collaboration to figure out where there are gaps, where there's opportunities to be clearer, be more succinct, to be more open about these fundamental tools that are being used throughout so many different aspects of what's been discussed so far. So that's one thing that we're looking forward to learning more about, hearing more about as the state regulators and the state DOIs start utilizing those materials hopefully to their benefit.
All right. Dr. Borman, anything to add?
Yeah, let me add, since Jeff covered the education piece, which was also on my list, but catastrophe models are tools, but we're in the business of science. So I think it's really important that from our perspective, we're doing a good job of describing how we're getting climate change into the models. So at Verisk, for instance, we have our core suite of models, and we're doing what's called the near-present climate in those models, which means that we are looking at the climatology up to today, right? And thinking about the historical record and how the climatology of today might be different from what we have in the historical record, and then calibrating our models around that. That's different than doing, say, a climate projection, right? So thinking about, we used to say 2030, we don't do that anymore, it's too soon. So now think about 2060, right? And what kind of modeling do we need to do around that to have a CAT model, have those representations in it, tailor the science to meet sort of those parameterizations, which are for different parts of all of this reporting that we're talking about, right? Like thinking about your yearly, year-over-year business, right? We would say that you would use our core suite of models, you would be thinking about the near-present climate versus some of the disclosures that have come along, which are more about okay, well, tell me about your 2050 number. And what does that look like, and how are you thinking about that? So both really important sides of sort of the same coin, but also when it comes to the modeling side of things, sometimes two different approaches that we have to take just to help our clients really understand their risk.
Okay, very good. I think that's an excellent transition to the next section where we want to spend some time talking about where modeling stands today, predictive analytics and so forth. It was just a couple of months ago, the NAIC, under President Gottfried's leadership and Commissioner Lara in California, hosted an event in Pasadena. And it was a day-long event, it was packed, and it was all about the state of the market in terms of the reinsurers, what they were seeing from their business perspective, but also spending a lot of time on discussing where the CAT models are today. There is some skepticism, right, still in the industry and probably more so in the regulatory community about the efficacies of these models, especially when they start to impact rates and rate filings. And again, through the Center of Excellence, we've been spending a lot of time getting out to departments, talking to the staff, CAP Modeling 101, we've got a 201, that's coming to help kind of raise that level of education. But Jeff, if you could start off, and then Julia, talk about where the CAP modeling science stands present day, and how that benefits the insurance companies and what the regulators can see from a second step away.
Sure thing. I'll share a couple points and then make sure there's an opportunity for Julia to hopefully complement some of that. When we look at the landscape of catastrophe models, there's different life cycles depending on the peril that you're talking about, especially within the United States. You've got some more well-established perils where we've had CAT models for a long time, like earthquake and hurricane. We're going on 25, 30 years, 30 plus years of having those models. That's a long time for those models to be developed, iterated, validated, and be deemed credible, and also to highlight where there's still opportunities for improvement. And then you fast forward to the last 5 or 10 years, and that's been the emergence of more of these CAT models for, whether you want to call them secondary perils, we kind of try to toss that term out the window if we can, but the wildfire, the flood, the severe convective storm, a lot of these perils that are becoming a lot more front and center, especially if you're in California for wildfire, especially if you're in the middle part of the country, really any other part of the country for SCS, and the most important thing we want to highlight, from a modeling perspective is the fact that they are indeed tools, but try to be open about, how we built them, how we validated them, because from that point onward, you get an idea of its fit for use, fit for purpose, and then to, at the same time, kind of track what's happening at the NAIC level or the state level in terms of, what more is being asked. Like, for instance, in the RBC framework, the expansion of beyond hurricane and earthquake to now include wildfire and SCS. Right now for informational purposes, sure, but eventually down the line there might be more being asked of those perils. And now also incorporating a climate change or a future climate state kind of view of risk in there. So what we're trying to do here is monitor the evolving risk landscape, make sure our models are reflecting that, and then kind of building on some of the comments Julia just said a second ago. If we're trying to incorporate like the flavors of a changing climate, let's say future state, just to keep things simple, because it might dovetail into what's being asked in the RBC. One of the big challenges is, like, you see what's going on in the science, like with the IPCC. You see how the market is using CAT models. How can you take what's going on in academia or with these research organizations, take it, spin it, and integrate it in a way that's already being used in a CAT modeling sense? And so that's what we're trying to do, is make it as easy as possible to make sense of what's happening on the outside with what you're trying to consume and make decisions off of within the CAT modeling space. So hopefully those are a couple themes that resonate here in the room, and hopefully, Julia, there's some things to either refute or maybe add to if you.
I don't think I'll refute you on stage, don't worry. Let me pull on that a little bit, which is, I think one of the most important things that we talk a lot about in the CAT modeling space, but that we're doing more of now, I think, out, in a very transparent way in front of a lot of different types of audiences, is how does the CAT model help you translate certain research, right? So you talked a little bit about the projections, but also if you think about the work that IBHS does, right? And so they have their roof farms, and they're peeling shingles off every year, and they're telling us how much they degrade. CAT models are how the industry gets to take that research, translate it, and then apply it onto their book of business, which is really key. So it's sort of the same thing in the future, the calibrations to future climate or understanding climatology of today. And so I think that's one of the most valuable pieces that CAT models bring. I also think that one of the things that, like I said, we're doing more of, and I hope we keep doing forward, is creating a more transparent space, right? So we have NAIC COE that's doing a lot of really awesome education efforts that we've been supporting. We have our documentation up there for the regulators for all the perils. We create these model cards so that they can easily digest what's in a model. We go out with them. So I was just at one of your zonal events for the Midwest, and we were talking to regulators about who in their department should be learning about CAT models. We did the wildfire review with California for the first ever PRID, and then after the PRID was over and we had our determination, Verisk put their documentation online immediately for the public to consume. I mean, we are actively looking to educate people about what are in CAT models, how they come together, and also, frankly, they are science. They are going to get better over time. So you mentioned like perils, we've been researching some of them for many years. If you talk to our research staff, they will tell you that there are limitations to CAT models because they are just models. They are not a complete representation of real life. And that's just how it is in building science. And so the idea that the CAT modelers don't know that their science can get better, I think is a fallacy I would like to dispel for everybody. It is something that we are working really hard towards. We put a lot of effort towards it. And I think we've made really big strides, especially for some of the secondary perils recently, wildfires, severe thunderstorm. There have been big model updates that have come out. So we're moving forward. It's going to make the reporting so much better. We're into it, and I hope everyone else is into it with us. But yeah, we agree, like the science is going to move forward.
Julia, thanks for covering the waterfront when it comes to the regulatory outreach. I know Verisk has been really instrumental working with the NAIC COE in terms of getting the education to a level that's essential for our members, but also just in terms of the technicalities around CAT models and kind of breaking that down, that it's in more consumable bite sizes for state insurance regulators. I'm curious if you could take a few minutes. I know you do some work, if maybe a lot of work with the rating agencies. If you could speak to kind of what those conversations have been. Throw back the curtain a little bit in terms of those conversations with the agencies.
Yeah, so my area covers the regulatory world and the rating agency world. Basically, I'm in charge of anyone who's effectively third-party consumes our information from one of our users. So the conversations are similar but different. So there is sort of a base level of understanding about CAT models and the fact that they've been used for so many years in the insurance industry. So we do a little less CAT 101 basic training, I would say, also because at the rating agencies, we tend to have a lot of stability of who we're working with too. So there isn't as much turnover that we necessarily have to combat. There's still a big question out there though about what should be asked, right? And should it be qualitative? Should it be quantitative? Like how do we approach those questions? That's very similar compared to the regulatory space. I think that they've been across the different data calls looking at certain perils very specifically for a long time, but the secondary perils, wildfire, severe thunderstorm, are also sort of making them shake their heads about like, have we been asking the right questions? Are we really capturing that risk? Like what is driving that risk? Is it frequency? Is it severity? Is it exposure, right? So all of that is common across, I think, everybody in the industry who's talking about this.
All right, very good. Let me bring in Jaclyn and Director Dwyer into this conversation around where CAT models stand from your standpoint. If you have any comments or perspective on that. Jaclyn, you want to go first?
Well, from the Ceres perspective, our concerns are that they would just continue to be, transparent and scientifically credible, as we move forward. We always encourage the adoption of new and innovative approaches. And this is but one tool in the chest of climate risk management. That's where we would stand for.
So from a regulator's point of view, anytime something affects the rates, especially in personal lines, it is of paramount importance. I remember going back about 20 years ago, there was 2 modeling companies, and I think they're both out of business. RMS and maybe AIR.
We were AIR back then.
Okay. And I remember a discussion at our legislature on which one can we mandate, which would be the lower rates. Really, well, please don't, first of all. They won't, and they didn't, so that was good. But, you know, again, we also, the people who work in insurance departments are not experts in this. You all are experts in this. So I think this is a place where the NAIC and the Center of Excellence through CIPR is really bringing a lot to the table for us, especially smaller jurisdictions like mine that can't afford to have someone on our staff that would really be an expert. We're really able to get education, as you said. There's been a lot of education both from the modeling companies and from the NAIC through the NAIC, which I think has really helped regulators. I think it needs, regulators, again, as you earlier mentioned, you really need to even know who in your department needs to know this. You know, the people looking at your rates and forms, sure, but how about your financial people? You know, how is this affecting your domestic companies? So I think, you know, the education that's out there, the acknowledgement that this is going to change over time, and, you know, we need to understand this and understand what it's showing us when we see the results.
Okay, very good. If I could add on to Director Dwyer's comments, at the NAIC level within the staff organization, we're spending more and more time holding classroom sessions at insurance departments, talking through examination procedures, talking about the climate risk disclosure, you know, all in an effort to position the financial examiners and the analysts in a position to where they can have an informed one-on-one conversation with the head of claims, the head of underwriting, and so forth. So that's going to continue in a very serious way for the foreseeable future. I think at this point, we've landed at probably 4 or 5 departments. We've some of the larger departments. So if you're an insurer, I think you can look forward to more of those direct, robust conversations happening over the coming years. So, coming back to climate risk disclosures and where they stand, best practices, if you will. Director Dwyer and Jaclyn, can you comment on where regulators and companies might get together to focus on closing that measurement gap? I know you spent some time around the targets and metrics, but going beyond that fourth pillar in the area of risk management, board governance, are there areas within the disclosures that you're seeing that maybe that's the next bite at the apple that the NAIC takes in terms of improving the quality of these disclosures and their usefulness?
So what we're doing is we're really trying to have conversations with our domestic companies. So that's the you know, the secret sauce of, at least in my opinion, of the financial regulation is understanding those companies and understanding what their risks are. And so we're really, it's a case-by-case basis, right? So if we see a company that we don't feel that the disclosure is appropriate to their risk, we're having that individual conversation with them to hopefully get the disclosures to a better level, which then we hope will translate to what Jaclyn does, which is the overall analysis.
Yes, and just to build a bit what you had discussed, Jeff. So Ceres has also been going at the invitation of several commissioners into their departments of insurance in providing that TCFD training to their staff, including the great state of Connecticut, actually, to give that background and context so they can better incorporate the survey into their financial review oversight processes. But what we also are looking to do is to create kind of these resources, these best practices, you know, recognizing that a good response is not going to be the same for every company. It's going to depend on company size, on line of business, and geographic concentration, and so forth. But just kind of building that conversation, those resources, those repositories of, you know, where you can look at what your peers are doing, kind of pull out best practices and adapt it for your own unique business processes.
Okay. All right, very good, thank you. Coming back to you, Jeff, again, in this area of, I don't know, advancements and best practices, talk a little bit about how Moody's is integrating more forward-looking information around fiscal risk, transition risk into the portfolio or the catalog that's being developed by. I should say Moody's Analytics, right? Because we want to make a distinction between the credit side and the analytical tools.
Yep, I think that's fair. So I'll probably talk more to the physical risk side and leave the comments on the other aspect of those risks to the rating side. But talking about the physical risks and the kinds of tools and the kinds of things that we folded into our CAT modeling framework over the recent years. Some of that comes back to these climate conditioned catalogs, and just to peel that back a little bit, it's already been discussed at this conference already, where there's confidence in terms of how a changing climate could impact certain perils, and then where there's a bit more uncertainty. So, some of the areas that we've really invested in already is on the hurricane side, the flood side, and then even more recently to the wildfire side. So just for instance, from a hurricane perspective, we are introducing different ways to look at different representative concentration pathways, so different CO2 emission scenarios over different time periods going out all the way up to 2100 in 5-year increments. So it's a way for a user to say, okay, I got to figure out what combination I want to look at, what time period I want to look at, because it might be part of the RBC framework. They say I want 2040 or the year 2050 and the RBC 4.5 scenario. So we have to make sure we're building these tools to help you quantify what that number should look like, quantify the magnitude of the problem, and then be able to be transparent about how we develop that kind of thing. So just as an example there. And then we also have other flavors of looking at forward-looking, future states of climate and how it could impact your book of business, for instance, around sea level rise or changes in precipitation patterns. And so all that kind of sits under a very growing suite of climate or future climate products. And then I really want to come back to a great point that Julia made, and it's been mentioned a number of times earlier today, and that is, when you talk about like the IBHS Fortified program, it's just a microcosm of the broader theme of mitigation. How do you quantify the impact of mitigation, the cost benefit of that, so you can actually go to a homeowner or a business owner and talk to them about, well, what happens if you decide to seal your roof a certain way or replace that roof? What's it going to mean to you in terms of financial benefits? Like, it's so important for us to be able to bring those mitigation factors and options into our modeling framework, so as a user, as an insurance or reinsurance company, you can actually go and do those sensitivity tests to know, okay, what's the cost benefit of this, and what's it going to mean for me and my business, whether it be from a rate-making standpoint or all the way up to the more aggregate portfolio management or even reinsurance purchasing decisions. So there's a couple of examples of some things that we're working on, things that we've been working on for quite some time, and hopefully that paints a good picture or gives you some flavor of what's happening here at Moody's.
Yeah, excellent.
Yep.
Julia, I want to come back to something you touched on in your earlier remarks when it comes to the California Insurance Department and the advancements, and they should not be understated, right? In terms of the regulatory advancements to help foster a more dynamic market. Talk a little bit about what that relationship looked like with Commissioner Lara and his staff, and specifically to the adoption of the California Department's recognition of the Verisk CAT models.
Yeah, so thanks. So that was a 8-year road that we were on, and it involved Verisk having conversations about CAT modeling with, we were in front of the commissioner, we were in front of the state assembly, we were in front of the state ledge, like we were talking about CAT models, and it wasn't quite clear for some time where the push would come from, right? Was it going to come from the ledge side? Was it going to come from a reg? And so we were involved in many conversations around that. When it was decided to become a regulation, there was a lot of active conversation with all of the modelers and the department about that regulation. There were multiple public forums that we all took advantage of to talk about our experience in what it takes to review a CAT model. So, we build CAP models. We also have gone through every known state review process at Verisk. So we are also I would say we're experts at getting models reviewed, which can be tricky business, but we've seen kind of what works and what doesn't work when you want to go in and like really dig into the models. Let's see, what else was really important? I mean, we've said this at Verisk in multiple forums. We invest considerable effort in building CAP models and considerable resources. We do need IP protections in place, and that was a big piece of the California regulation that went through. But when there are IP protections in place, we show up, and that's why we were first through the door on January 2nd, right? So the department was able to create those protections for us. We were able to go in. It was a public review. Consumer Watchdog was in our review with us. For anyone who's worried they can't learn a CAP model, I will tell you this. Everybody who works for a catastrophe modeling company didn't know what it was before they got there.
Right.
I showed up after my PhD. I was like, I know insurance for agriculture, and I was hired onto the research team. I had no idea what a CAP model was. We teach everybody what a CAP model is, and we're really good at it. And that's also why we worked so closely with the COE when it was stood up, because we recognize that that is institutional knowledge that we need to push out, right? And so that was another big feature of California, is when you have a very public review process like we did, then you need to also be educating throughout. And so a lot of the early meetings that we had with our participants were just to onboard them to the process of building a CAP model and where certain things were going to show up. Overall, a great, I love the result because I was first through the door and I was first out. We got our determination, and really proud of the science that we put forth in that model. We had released it in June of 2024, so I got to bring it to market really quickly as a part of this submission process.
Yeah, thanks for sharing those insights. I know many of us read about those developments in California, and it's certainly a success story given where the department has been over the last several years with the wildfire losses and so forth. We do have a few questions from the audience. I think we can maybe take a quick hit on a couple of these. Are there any states following SEC framework instead of TCFD? Anybody want to
I don't think so.
Well,
My understanding was the SEC
is
based on the TCFD structure
right, so,
with modifications. Yeah.
right, so perhaps more internally, but what they're providing to the regulators is TCFD.
TCFD. Okay. Are there any free CAT modeling tools?
Oh, that's a good one. There is the public hurricane model that is built out of Florida. And of course, California, I don't think it's been signed, but the law is sitting on Newsom's desk about building a public wildfire model for California. Those would be once the wildfire one's in existence, but those would be the two public versions of the model.
Okay. All right. Very good. Hopefully that was responsive. And the third question we have here is, with regard to climate-related risk specifically, what are regulators, quote unquote, really interested in knowing about their regulated entities' ERM framework?
Are we really interested?
In
We're
quotes.
really interested in
Yeah.
knowing whether you understand your risk. You're not going to somehow
I think
ignore risk.
they may be looking for, are there kind of pieces of disclosure insights from the company that may be a bit of a litmus test? I don't know, that's my word.
Yeah,
of
I think
cluing
that-
in the regulator as to whether the company has a handle on things.
I think it depends on the company, right? So, if you know your company well and you understand what they're writing, and then you're probably going to be able to really understand their TCFD disclosures better. But I can't say there's any one or two things that are litmus tests.
Yeah, the last thing I would mention comes to mind on the climate risk disclosures. The COE, the NAIC COE, is partnering with the Society of Actuaries, and this is a project that's underway now in developing a large language model. So applying AI, the AI tool, to the entire universe of disclosures. And my understanding is the aim is not only to produce an analysis of those disclosures, but at some point in the future, provide that type of tool for the regulatory community as they delve into these disclosures. As we all know, any number of them are quite dense in terms of the information and the terminology, phraseology that's used, but that is something CIPR, Center of Excellence, is, again, working with the Society of Actuaries to advance. So we're down to 3 minutes, and I have a closing question for each of the panelists, so we'll do a bit of a rapid fire here. Where do you see the greatest opportunity for regulators, insurers, and data/modeling providers to collaborate over the next 5 years? Which areas?
So I think we're hopefully doing a pretty good job now, but I don't think any one area would solve the issue. So I think the working with the providers who are looking at models, the data that's coming out, I think it's all important, and I think we're just going to move forward as we have been.
And we would agree. It's that the importance of that collaboration. It's not just the regulator's job to fix the issues inherent with climate risk. It's not the industry's. It's that spirit of collaboration, public-private partnerships on every element surrounding climate risk to continue to move the industry forward.
Yep, I would say, one thing I would totally agree with all the comments that have been made. One example I might want to give is, when it all comes down to what gets reported on some of these disclosures or in like the RCB framework, it just comes down to some numbers, especially in like more quantitative based asks. So one thing I would really harp on is when you are educating yourselves about CAT models and learning more about CAT models is pay attention to more than just the number. Learn about the ins and outs, the assumptions, the uncertainties, because there's some models that are still in their infancy, and there's some models that have been out there for a while, and so that can make a difference a lot in terms of what a small shift could mean down the road, and that's one area that, as collaboration deepens and gets tighter between the vendors and the entities that are using the CAT models here, is to really go and peel back that curtain a little bit beyond just the numbers that you see.
I guess I'll add that as we move forward, there's going to end up being a common language that sort of falls out of how we talk about these things. So in particular, right now, I feel like a lot of people are like asking us, what's a CAT model and how do I think about it, and what are the terms that I should be using? And so what I expect to see over the next 5 years, like Beth said, is like we're moving forward on it, but I think we're going to end up in a better space of having a common language about how everyone sort of wants to phrase things and create those common frameworks that folks get used to and can report to more easily.
Okay, very good. We are now in the red time zone, I think, but I want to thank everyone for your attention, especially right after lunch. I think this has been a fantastic panel. If you would all join me in a round of applause. And now we will get Director Dwyer onto her train.
And both of us.
Thank you again.
Thank you very much to the panelists for that conversation. I'm not going to lie, I know I'm a novice, but I really thought CAT modeling was going to be a different portion of today's event. I know that that's something else now, I guess. At this time, I'd like to welcome up our next guest. We've talked a lot about modeling, mitigation. We've looked at climate. We've looked at a lot of different aspects of this conversation, but our next topic of discussion is a really critical one. We're going to look at the health impacts of climate change and insurance solutions. We're going to talk about how climate risk is reshaping health insurance and public health strategies. And to help us do that with our next panel, please help me welcome Dr. Medicci, the Commissioner of Connecticut's Department of Public Health. Thank you.
Hi, Jen, Maureen, really nice to meet you. Nice to see you.
Hello?
All right. Boys and girls separate.
Yeah, apparently.
Oh,
Sorry,
I don't think
it's not so like.
doesn't.
We have a full panel.
I think so.
Looks like we've got everybody. All right. So let me just see. So you're Marie. Tell me your name again. Tell me your name again. David, right? And Matt? Yes?
Adam.
Yeah, thank you. Okay. Okay, well, good afternoon, everybody. I'm Dr. Medicci. I'm the Commissioner of the Connecticut Department of Public Health. And this is a great opportunity for us to really discuss the health impacts of climate change and insurance. So to frame out this topic for you from the perspective of the health department in the state, for all of us, we are well aware of changes that have been happening in climate and its impact on health for quite some time. Whether it be looking at air quality when there are wildfires on the West Coast and we see impacts directly in our own state, to seeing increases in vectors, new pathogens in the state, a whole list of infectious pathogens that you can think of, from anaplasmosis, babesiosis, ehrlichiosis, malaria in Florida, dengue in Florida, all of these pathogens moving up the eastern seaboard, to pathogens like Vibrio that's in the water, and when we've had warmer water, people having more infections. In 2024, we had infections in North Carolina, in New York, Connecticut, to the impacts we see in asthma rates in our kids, even in adults, attacks, particularly as I mentioned with wildfires, where we see increases in hospitalizations, increases in emergency department visits. These are all things we see in real time on a regular basis and that we monitor as a health department. And as a health department, we don't have the levers to reduce greenhouse gas emissions, to do the things that might be able to change the trajectory of those health impacts. What we can do is advise people. We can put out advisories and educational material so that people can make those decisions in real time. For example, when we had those problems with wildfires, and we were seeing kids under the age of 6 showing up in emergency departments more often, we did partner with our early childhood partners to say, maybe this is a day that the kids should not be playing outside, and we should just keep the kids inside today. Those are the types of real-world impacts that we are seeing every day as a health department, which is why we have an Office of Climate and Health, and we really look to partner with people throughout the state as it relates to these impacts. And we have a really fantastic group of panelists here today that are going to share their perspectives from each of their viewpoints in terms of this topic. And I want to give each of them about a minute to introduce themselves. And I'll start right next to me with Marie.
Thank you so much. Good afternoon, everyone. I'm Marie Grant. I'm Insurance Commissioner for the state of Maryland. I'm coming up on a year in the role tomorrow. And prior to that, I was actually Assistant Secretary for health policy at our state Department of Health in Maryland, which is a super agency. It handles public health for the state, as well as the Medicaid program, as well as behavioral health and developmental disabilities. So I speak a couple of languages. I speak insurance and I speak public health. And I just, the perspective I bring to insurance regulation is that, understand the product and insurance, but also we can't lose sight of the fact that these are products that impact people's lives, and it's really about ensuring the risk of people, right? So really looking forward to the discussion today.
Thank you.
Hi, I'm David Rabinowitz from the Deloitte team. I've got the privilege of leading our healthcare sustainability efforts in the US as well as in a number of global markets. We've taken a very broad vantage point for what sustainability means, especially in healthcare. It's not only the emissions that healthcare providers, health plans, other health-related companies produce, but it's really, and more increasingly, I think the point of this panel, what is the impact of climate, of other social, other economic, other environmental needs on the health of people, on families and communities, both from a quality perspective, but also increasingly from a cost of care standpoint. I always start with what do we actually need to be healthy, and it's not just healthcare. It's jobs, it's food, it's clean water, it's clean air, it's information and agency. And so really making sure we're taking kind of the broadest possible view of what do we need to create those conditions necessary for everyone's health and well-being.
Great. Good afternoon, everyone. I'm Jennifer Wong. I'm the Executive Director at the Yale Center on Climate Change and Health. It's a pleasure to be here. I'm not sure that I speak the insurance language, so I'm very glad to be learning with the audience here and really connecting with you all. I think it's incredibly important to have this health and climate and insurance connection. Our center works transdisciplinarily across Yale and with external partners on research, education, and policy and practice, really focusing on the health impacts of climate change and the health benefits of climate action. I think a lot of the themes that we are seeing today around thinking upstream, looking at prevention and mitigation are all things that we look at from the perspective of health impacts, especially protecting the most vulnerable. Thank you.
And I'm Adam Seidner. I'm Chief Medical Officer at the Hartford Insurance Company. I am board certified occupational environmental medicine doctor and really focused on individuals. So we talked about resiliency. I'm looking at resiliency of individuals and populations as opposed to property and the environment. And so with that, I helped the Hartford get answers to some major questions that they have and the industry has. And so we do quite a bit of research and build alliances with a number of organizations, which I'll mention a few throughout the course of today, to really help our customers, the employers, as well as the individuals through some of these climate exposures.
So thank you for that. I think where we want to start right now is just starting with framing out what some of the most pressing health impacts from climate change are right now, and what evidence is really emerging to show us what that is. And so I thought we could start with Jennifer, if you will, to just sort of give us your perspective as somebody who studies this all the time, what you see the most pressing impacts.
Thank you, Commissioner. And you've already mentioned some of those impacts that we're seeing here in Connecticut. I just want to maybe take one step back and say that in terms of climate, the climate reality is that we are living in a perilous time. I don't think that anyone of us would argue against that, but I just want to say for the record, 10 of the hottest years since 1850 have occurred in the last decade, right? So the last decade was the hottest, and the frequency and cost of billion-dollar disasters have gone up since 1980. At the same time, data access to be able to track all the stuff that's happening is being dismantled at the federal level. And so this is the moment we're in. And in terms of the health impacts, I think that I think the overview is that health impacts are broad across a spectrum of diseases, across all organ systems, across all life stages, including prenatal. The let me just maybe use an example of heat, because I think that's the one, maybe that's the most familiar. And I think that you can think of heat stress and heat stroke and premature mortality as some of the most obvious health outcomes that we might see. Some of the researchers at our center, and this is all, like, anything I cite is papers that have come out within the last few years, they actually use some health claims data to look at the effects of heat and ozone on heart attacks and strokes. And there is an association, and what's maybe surprising about that data is that that's true even for younger populations, where you might not expect some of those effects. Another researcher from our group, through a pilot grant, looked at data from California birth cohorts and saw that increased prenatal exposure to heat actually was associated with the development of childhood lymphoblastic leukemia. Looking at mental disorders, so again, researchers from our group had data from New York State and saw an increase in emergency department visits for mental disorder episodes. Beyond heat, I think it's really important to think about wildfire. We've talked a lot about wildfires and floods. And from the sort of property, like the PNC, I'm getting my insurance acronyms. The PNC perspective, I think there's been a lot of discussion about that. But I think from the health perspective, I used to work, so I've been working in climate health for 10 years, and I previously worked on air pollution related to coal-fired power plants. So I feel like I know a lot about PM 2.5, because that's one of the major pollutants, most harmful pollutants. And beyond the respiratory effects and the running eyes and that cough that a lot of us experienced in wildfire episodes across the eastern seaboard, across the Midwest, across the West, beyond those respiratory effects, the asthma ED visits, the exacerbation of COPD, there is the cardiovascular effects. So again, heart attacks and strokes, very strong evidence around those increases with acute and prolonged exposure. One of the scariest things that I don't think people know about PM 2.5 is that it is classified as a Class 1 carcinogen by the International Association for Research on Cancer. That's the same class as asbestos, tobacco smoke, and UV radiation. So it's very strong evidence. And a lot of these harms come from the size and the composition of wildfire smoke and PM particles. They're so tiny that they not only get into our lungs, but they can enter our bloodstream, which is why they cause inflammation everywhere. In terms of composition, it's what is burned is what is in these particles. And so when you're thinking about burnt vegetation, there's these polycyclic aromatic hydrocarbons that are, by the way, they are also carcinogenic. There's heavy, when they're burning homes and cars, in industries, that's heavy metals, that's loads of plastic. And so that is going to have some really important, serious long-term effects for the populations that are exposed. There's also the impacts on soil and waterways, right? So like accumulation of the food chain. So I think there's a lot of concern around wildfire smoke that may be under-recognized, perhaps in the broad public, perhaps in the insurance industry. I don't know, y'all have to tell me. And then flooding, same. I think there's recognition of the displacements, the injuries, the death at the acute and immediate level. But then if you look at the longer term effects, there's the mold, right? And a lot of sort of like the sequelae of that in terms of skin infections, respiratory diseases, GI issues, mental health impacts. So I think just to sum that up, it is, I think, beyond kind of some of the more immediate and obvious things. And there's this body of research has been around for a couple of decades, but it has matured, it has advanced, and the news is not good.
Well, on that uplifting note, Joan, thank you for framing it out for us and how we're all going to fare. And so, Adam, maybe you could tell us a little bit about the data that you collect at the Hartford, and particularly its impact on mental health and what you're seeing among people that you get data from on productivity as well.
Absolutely. And so just one of the other things I wanted to point out that you don't think about sometimes, the supply chains and shortages that occur with some of these events. And so, when we had some flooding down in the Carolinas, we had a shortage of crystalloids, saline solutions, things like that. So surgeries were delayed because of that. So you have to keep in mind how big the universe is as we're dealing with this. The Hartford, yeah, so the mental health aspects of all of this are real, and what the Hartford really focuses quite a bit on. It impacts everything from the quality of life for the individual. It impacts the employers for their employee retention, prevention, presenteeism, productivity. All of this is important. And there could be everything from fear, worry, and distress that go along with this, as well as the aggravation of any other mental and behavioral health issues. So the Hartford did, in this year, 2025, we have something called the Future of Benefits study. We actually survey the U.S. Employers and employees, and we ask a number of questions, what workers would specifically like, and employers what they're actually doing. So 60% in our survey, 60% of the workers would like their employers to provide more mental health resources. So that was interesting that was that much. And in addition, employers can improve resiliency amongst the employees by providing a number of things. Flexibility of work schedules, especially around any of the events, things like that. If there's a weather issue, the heat we talked about, but there are other cold events that occur as well. Financial help was one of the challenges that people experience, and so there's a number of ways that employers can help their employees. We've talked a lot about parametric insurances. The Hartford has some versions of parametric insurances, so if there was a cardiovascular event or a cancer or something like that came up, then we have a critical incidents insurance, which just gives the payout if they have that diagnosis. So that's important. But I think more interesting is what's going on in India. And they basically have a parametric insurance through Swiss Re. They're working with SIWA, which is a self-employed women's association. And they basically have a threshold that if a temperature hits 110 degrees there, so pretty high, but that people don't go to work and they get paid. So that's an example, I think, in India that we can take a look at. Obviously, 110 may vary depending on what part of the country you're in, but these parametric insurances, I think, are very helpful. The only other thing I'll mention with regard to our Future of Benefits study is that support in the form of mentoring programs as well as employee resource groups and other resources as well. So when we can talk more about EAP and other resources that are available as well, employee assistance programs. Thank you.
Thank you. And so, Marie, if you could share with us a little bit the perspective of the state and what you really see the trends are from insurers so far.
Yeah, absolutely. So, well, first of all, when I hear Jennifer talk, I hear costs going up. I've just, a couple of weeks ago, signed off on a 13.4% increase in our individual market, which is the market that serves our individuals and businesses. And, a lot of the costs, and we're seeing a particularly high jump this year because of the loss of enhanced tax credits that's anticipated, that you may have heard about recently, or may tomorrow. But like underlying that, right, like what the costs are that are included in major medical hospital policies. In Maryland this summer, we had record heat and humidity for a really sustained length of time. And so we had the highest number of heat-related deaths that we had seen in 10 years. And then, which is just tragic. But then right behind that, when you see those level of deaths, there's hundreds more ER admissions, right? There's hospital admissions associated with that. There's all kinds of health impacts that translate into costs. There's exacerbation of chronic conditions, which turn into pharmaceutical costs. And so I think everything we're seeing in terms of healthcare cost trends generally, I think we're talking about seeing those get exacerbated over time by climate change.
So just sticking with that for a minute
Yeah.
with you, Marie, what do you see the role of state regulators, public health departments, as we try to address these evolving health risks going forward?
Yeah. So this is where I'm going to put my insurance hat on and say, you know, I think we as insurance regulators, our role isn't necessarily in that public health and population health sphere generally, right? We are looking at rates, we are looking at solvency, but I think, and you heard from the last panel, and I know we'll talk about a little bit more as we go on, this TFCD reporting and giving insight and really pushing our health insurers to think more about the risks they need to manage for in the future is just really critically important. A couple other just thoughts I have about the role of insurance commissioners and sort of our plans is, first of all, just the importance of keeping in touch with our departments of public health, right, and our public health regulators in Medicaid about what they're seeing. And then just, you know, one of the key roles that we play as regulators is being that addressing emergencies, right? So if there are, for example, we had severe flooding in Western Maryland this past year. We, as the insurance regulator, put in emergency action to make sure that folks could get their medicine without restrictions, right? That we're removing barriers to health created by events that are probably caused by climate change. And so I see that's probably going to increase in the future.
Yeah. So David, how do you think CFOs and health plans should be thinking about this? Should be thinking about the regulatory space and where the private sector meets it?
More. So I think it feels right now like we're in a tale of kind of two very different approaches to this, and I'm heartened seeing more and more that health becomes the center of this conversation. I think it brings the temperature down. I think it makes it a more accessible discussion, and I think sometimes when we've talked about these big climate-related topics, it feels so diffuse to people, but I think when we put health at the core, it is, I think, a value and a set of principles that we largely agree on. And so I think, that being said, there's a set of actors in the industry that I think are still hoping that the regulatory environment compels them to act. We've seen that more in other industries that feel more subjected to largely the European standards. But I'm really heartened to see a set of healthcare organizations, especially in the private sector, seeing that this is now a material business topic. And to the other points that you all have made, the risk and the cost associated with the risk is very, very clear. We've seen studies where, when the ambient heat is over 80 degrees Fahrenheit for 3 days in a row, ER utilization spikes. That's cost. And that manifests in a variety of ways. And so I think there's an opportunity for health plans to really think about not just what they do to manage the risk, but where do they create value? If I had the power, I would be building behavioral health clinics and early cancer screening capability all over the parts of the country that have been ravaged by wildfires. Like, we know it's a very predictable pattern what the epidemiology will teach us, and I think that actually gives us the chance to have an early warning system for where health needs are going to go in the future. And I think if you think about it from that perspective, like, you actually see a set of opportunities to better serve patients, better help communities be resilient, and also drive the appropriate kind of financial value of the issue.
I think you raise a great point, because at the end of the day, I think it's very tangible where the costs are going to be and where the opportunity is to potentially intervene early. And so, Jennifer, just going forward from there, can you comment a little bit about looking at all of this through an equity lens? Because I think some of what we just heard David talk about too is, where are the risks? Where are there maybe gaps in healthcare delivery or access? So do you have any thoughts on that?
Thank you for the question. I've been thinking about this even from the first panel of the day, and really thinking about these upstream, like, how do we think upstream? And maybe another framework that I don't know if you all can picture the Venn diagram of the definition of risk, which I don't know what it is in the insurance industry, but in public health, it's like hazard, exposure, and vulnerability, right? So hazard, exposure, vulnerability, and then risk is like that intersection. And so the hazard part, maybe I'm gonna get back to the hazard last. In terms of exposure, I think there's a lot of opportunity. So I always think of like the Chicago heat wave of '95 as this like telling example that many people are familiar with. And we know a lot of elderly people died. We know that they were primarily lower income. And what is that exposure, right? So the exposure came from the hazard, but a lot of it was because of lack of air conditioning, inadequate air conditioning, people having their windows closed because of street crime in these like lower income neighborhoods. And so a lot of that kind of built environment really exacerbates the exposure, like urban heat island effect, all lack of green spaces, all of that contributes and affects exposure like outside of the individual level. And then vulnerability, again, it's age, it's socioeconomic status, it's gender, it's like social capital, right? Like your public health infrastructure, your mobility, your ability to go stay with a friend, or you're just like housing quality and housing tenure and security. So I think those are, I think if you look at that in terms of risk, I think those sort of tell the story about the levers of action. And I think that for states, like Connecticut, it's great to see like, the insurance department convening this, our health commissioner moderating this panel, and just other Department of Energy and Environmental Protection and Office of Policy and Management and Department of Labor and many departments in the Department of Housing, obviously, most very importantly, coming together to coordinate and to look at this multi-sectorally.
Thanks for that. So, David, I want to come back to you again on thinking a little bit about what levers you think currently could accelerate action on climate and health in the insurance space and in the healthcare sector. How can we better translate evidence and research into driving business decisions and policies? You touched on this a little bit with making the cost calculation evident to people with keeping health at the focus. But if you could comment on that a little bit.
Yeah, I think there's a few ways to think about it. I think there's more to be done on the data and the analytic side. I think you've done a phenomenal job kind of translating the academic public health literature, but I think more needs to happen to kind of bring it from the, here's the social benefit, here's the macroeconomic benefit, into here's the benefit that actually accrues to the line of business that someone cares about, and either at the member or the pop health level. I don't know how you manage a value-based contract without factoring this into the equation. And I've got a kind of simmering belief that, and I'm curious about this, you might actually have the data, how much of the cost of care increases that we're seeing over the last 12 months are actually due to the lingering effects of an underlying level of acuity and illness that we've not picked up in the actuarial data because we've been kind of stuck in some legacy ways of thinking. I think some of it is a coding question, but I do believe that a meaningful amount of the change is probably because through COVID we are sicker than we have appreciated, and climate is playing an important role in that. So I think there's a really important data conversation, and I think the plans are sitting on loads of it. I don't know that they're asking the questions necessary to look deeply into it. I think there's work around what are we actually going to do about it, and I think that's been an area, especially on the clinical front, where I feel like we haven't had clear enough kind of guidance and evidence on how do you change a clinical protocol based on an exposure or an individual kind of level of climate risk. If your 90-day fill is sitting in your mailbox for a week in the sun, does the efficacy degrade? If you're balancing a statin and going outside, what's the trade-off that you're willing to make? And when I talk to physician friends, I don't feel like we always have the guidance necessary to do that. Same thing operationally. We had a discussion last week on climate and health and the youth perspective. Do you close a school on a high heat day? Do you give up the educational benefit because there's an environmental hazard? But how do we start to make some of these trade-offs? I think it's going to be a really important what do we do based on it? And then the third lever, to me, comes down to leadership. And I think this is a space where we kind of know that we need to do more than we're doing. People want to see more data and more evidence, which is incredibly important. People want to have more clarity on what to do about it. But at the end of the day, I think the leaders, the boards, the executive teams across the industry have a really important role to play. And I'd love to see more, be willing to be out in front, be willing to be bold, and be willing to do what we know is necessary.
So you brought up a few interesting points on data, coding, and Adam, I thought maybe you could just comment specifically on how you think employers and insurers can implement protocols around coding and metrics to make those actionable items real for CEOs who are running insurance companies.
Yeah, the short answer is we have some kind of incentivization type programs. And so we can talk about, is there a decrease in premium, or is there credits, things like that. But behind it all, we need to know what the ROI, impact is going to be, the cost benefit. And so knowing that what's the quality of the data, we have to ask that question first, I think. And so it really comes back to, especially since a lot of the health issues that we're dealing with are coming from the physician data submissions for their bills, the electronic medical records, and are they capturing it? How good are the ICD codes, the diagnosis codes? But we've got other procedural codes that we can look at. We can look at durable medical equipment codes. We can look at other systems. So the National Council on Compensation Insurance has, a coding system that we use in the work comp world, and that can help as well. So we look at all of this, which gives us as a payer, carrier, insight, but again, it's only as good as some of the data that we're getting from the physicians as well. And so the capture of that data, the quality of the data, I think still needs to be enhanced. As I mentioned, I think the socialization of the risks, the conversations that we're having, both economic and the health costs, need to be looked at very closely, because you can have a trade-off. It was mentioned at an earlier session where, what are the health costs and what can the health carriers do to assist in mitigating some of these issues as well. The only other thing I would say is we as carriers with our customers, it's nice if we had a consistency of climate standards that were out there as well. And so if you look, we've got states that have different heat standards and so on, and some may just be specific to one industry. Another might be more for just indoor heat. Another might be just for outdoor heat. So I think all of that and getting, employers a little bit more activated as well is helpful. And then the other thing is, in all the conversations and the research and answering questions, there's a Health Action Alliance that the Hartford's part of, and we have been, developing with Mercer and others a calculator that can show the employers. I think you have to show them the financial impacts and the potential benefit for acting rather than just letting what's going to happen.
So Marie, you heard the question that David asked you in the beginning. I don't know if you have an answer to that in terms of any sort of sense of cost, as it relates to things that maybe have been billed for, but could you give us any information you might have on that, and also just any insights you have on insurer reporting as it relates to this conversation?
Yeah. So the question that David asked, I wrote down here because he said, I think insurers have the data. I don't think they're asking the right questions. Did you say that? The right questions.
This is off the record.
Maybe I translated that.
Yes.
But I think that's like such a powerful insight, right? Because it is what are those right questions to get us to that risk, right? I can tell you right now that, like, at least in our actuarial review, no, we don't have that data, right? But we do have an all-payer claims database in our state where we could start to do some of that work, right? And make sure that we're getting prepared as a state to ask those better questions and get some better answers. I, took a look at our health insurers, TCFD, filings that also sort of indicate, right? Like insurers are thinking about some of their business operations, emissions, but that area of studying, understanding that risk, much less building it into products, is not quite there yet. Still thinking about that. There's opportunity there. I guess the other thing that I would say, and I think, Adam, you touched on this, right? The cost benefit of the intervention. One of the things that I think is challenging for healthcare financing programs generally, whether they be in our fully insured market, whether they be for our Medicaid programs, whether they be for self-insured employers who are looking to understand what the benefit of the intervention is the time horizon of the intervention, right? So for our fully insured markets, depending on the market, folks may have an average length of stay of a year or less. Employers, right? You may pay for something and then someone may switch jobs, or they may go to Medicare and Medicare may see the benefit of the intervention, right? So that's something I think I know we'll talk a little bit more later on, but I think that's something we're gonna have to wrap our arms around, as well as how in this life and health space do we appropriately incentivize the interventions.
So, Adam, I'd like to turn to you now and ask about how you think health inequities can be identified, measured, and used in designing insurance or resilience programs for employees that you have. And what data do you think we need to better model health risks and integrate them into insurance solutions that are created?
Yeah, there's a lot there, but basically, you need to understand the vulnerability factors. And one of the things that we are just starting to look a little bit more closely at, I think, social determinants of health. That really has sometimes the biggest impact on health of an individual. So everything from food insecurity, housing insecurity, transportation access, you name it, there's a lot there. But I think we have to look at that, and then you can see that it's broken out sometimes by demographics. And again, different age groups will have different reactions to certain exposures. Geography is a big part. So do you look at metropolitan statistical areas, or people are looking at counties and zip codes, things like that, but you're able to then focus in where those resources need to be had. So if you're keeping all that in mind, add in all of the medical that was started to talk about, the medications in particular, do they have access to the medications? But if they're taking their medications and they already have access, what kind of risk does that put them at in a hot and warm environment? So I think having all of this and working again at different levels, especially with the employers, you can develop, different kinds of heat illness prevention programs, for instance, if we're talking about heat. And so the Center for Construction Research and Training has put together a beautiful checklist that's out there, and I think getting employers familiar with that and having them put together and develop a heat illness program, that addresses issues around even acclimatization, so the body will get used to it, but the heat, but you need to introduce it to that expose it in a different way, over a period of time, because most of the events of heat exhaustion, heat stroke are occurring, on day one. So, let's get and use some of the things we know about what the body can do. I think there needs to be established trigger conditions for implementing the HIPs as well, the health illness prevention programs, and really have a response and plan in place. So, encouraging employers to adopt these kind of measures will help them, especially if they're, in multiple jurisdictions and multiple states, to be able to identify those employees at risk. And really, the education of the supervisors and the implementation of these programs will be critical.
You know, I think it's interesting from the perspective of somebody in the health department, and those of you who are not from right around here, and you think about I-95, 91, 84, communities that live right off these highways. We know, for example, in our state, a town like East Hartford, right off the highway, that's where our asthma rates are the highest in kids. It is predictable, it's consistent, and it's been like that for a long period of time. And you talk about exposures. And so, you know, Jennifer, as you think about what role academia can play in this space as we try to help think about the gaps and research that can be filled, what do you see academia's role right now?
I see academia's role as being in more of these kinds of conversations to understand, like when you design, even from the point when you design your study and think about the geography and the increment of the exposure that you're measuring, like all of those details I think can be really enriched and refined through these types of conversation with insurers, you know, like outside of academia, basically. I know that attribution science came up in the conversation earlier, so there is a lot going on academically. I mentioned just, you know, all of the science along different, you know, diseases and life stages, but the attribution science is really getting at, you know, what proportion of some of these health outcomes is attributable to climate change in particular, rather than just the association. I think there's a lot of interesting work being done there, looking at, again, beyond heat, but looking at like mosquito-borne disease, like the vector-borne diseases and other infectious diseases, looking at, you know, the air pollution and the wildfire smoke, looking at floods. Like I think there's, one of our colleagues did a review of health attribution studies that came out in Nature Climate Change a couple weeks ago, and it was showing that from Hurricane Harvey, the life years lost from all of the effects came out to $17 billion. There's a lot, I think, there related to children and all of the sort of climate-related impacts, I think particularly preterm birth, which has a lot of sort of lifelong consequences in terms of development of asthma and types 1 and 2 diabetes and cognitive impairments. A study in China quantified that at $300 million per year. And so the question then is, right, like how do we better protect pregnant people? And then there's also, of course, the rest of the working population. These are the types of questions that I think, you know, academics like are interested in these questions, but to the extent that their questions can be further refined, I think really involves these types of conversations.
So, David, you know, you mentioned a little bit about this before, about the business value of actually looking at these data and incorporating it into the models that insurers really look at. How do you think that insurers and providers can act on these data once they're available? And I will just say that my hidden fear is that your zip code or where you live will become a pre-existing condition, because it is in a way. And I worry that insurers will use it in that way. And so I think what we're looking for, I guess from a health perspective, my perspective would be, how can we use it to help move the conversation forward and make the business value of that to insurers without necessarily penalizing people for where they live?
Yeah, well, I'm grateful to both of you and the types of work that you do to make sure that there is the kind of protection against, you know, where harm can spread inadvertently. We did a study last year estimating that if we got to better health outcomes in America for everybody, basically raising every state to a level that is doable today based on which 10 states have the highest levels of healthy life expectancy, we'd see GDP grow by $2.7 trillion between now and 2040. So there is, I think, a clear business case on how addressing health hazards, health vulnerability, health equity drives the economy, and a meaningful chunk of that, about $800 billion, would flow down to the bottom line for the private sector. We've done the same thing on the cost side. Health disparities cost the country $320 billion. That was a 2019 data point. There's been other studies that put that closer to the $400 or $500 billion mark. That's going to grow to $1 trillion plus by 2030. 2040. And we've also seen more work around the value of prevention, and this is your point that you keep making about going upstream and preventing illness before it onsets. And I think the belief for a long time has been prevention just delays total cost of care and it still spikes end of life. And we've done some new work to try and refute that claim and say we actually see an overall lessening of the total cost of care curve to about $2.2 trillion by 2040, which would actually drive the opportunity to really look at Medicare solvency in some different ways. So I think that the numbers are there at the macro level. I think the work for the health plans to do is to translate that to their own areas of focus. And I do think part of that is going to be we're going to have to refute this belief that churn prevents doing the right thing. And I know that is like the prevailing line of thinking in a lot of our conversations. And 9 months on Medicaid, maybe it's 3 years on a non-MA senior. But I think how do we start to get more longitudinal data? The other part that I wouldn't discount is the qualitative data. And I think this is a space where the power of storytelling, the power of narrative becomes incredibly important. And I've been really impressed seeing some of that come through from the kind of provider workforce element. And we sometimes forget that as we talk about the effects of these events on communities, the clinical workforce is part of the community. And the stories that we've seen around, the physician who is driving to the ER to treat wildfire while his wife's on the line saying, what should we save from the house? I think are starting to really kind of change the level of empathy and kind of the human element that we can't forget that side of the data as well.
Thank you. So for everybody in the audience, if you've had any burning questions, please put them into Slido. I've got one more question
happy
for the group. Yeah, happy questions are good. Happy questions are good. And we'll try to get to as many of those as we can as well. And so, Marie, I want to ask you how you think insurers support health resilience and reduce the risks for vulnerable populations, because it is the same vulnerable populations that are impacted most by the climate issues that we're talking about right now. So they are communities where there's already an undue burden of many chronic diseases that are only amplified and exacerbated. So what do you see the role of insurers in that and supporting that?
Yeah, well, first of all, even just the coverage and making sure that folks can get their health needs met when they need to and have access to that is incredibly important. I think I would encourage health insurers, first of all, to be thinking more strategically, to be building these climate change and all the things we've talked about today into not only their risk assessments, but in their more near-term strategic plans and thinking about how they can address them. I do know that health insurers, especially depending on the market, have been thinking more over the past 5 to 10 years about non-health related interventions, right? Whether that's, we call that social determinants of health, health-related social needs. Some of the things we've been talking about in a world where the climate is changing are interventions that may not be exactly medical, right? So to prevent heat exhaustion, that might not look like a medical intervention, at least on the front end. To address asthma and air quality in homes, right? Sometimes the way to do that is not just medical interventions. And so I think we need to continue to have those conversations with insurers, as well as make sure that we're all staying connected, again, with our health departments and having that cross-health insurance conversation overall.
And so, Adam, what do you think are some of employers' best practices as it relates to heat protocols, mental health interventions?
Yeah, and again, having that in checklist, having a program that's activated in certain environments, temperatures is important. I think really the mental health aspect and supporting the resiliency of the population is going to be critical here. There's different resources, NAMI, the National Alliance of Mental Illness, and others, Active Minds and Milken Institute, have a number of resources that we can share with our customers, employers can get access to. We also are always looking at potential apps that are available that can help individuals in times of need. And so as we go through all of that, I think the training, the protocols need to be in place so that everyone knows exactly what it is. And the training goes not just from the supervisors, but to all the employees. And so they can also help support a coworker if they're having, you know, some behavioral health, mental health issues as well, so that they continue to stay at work and be productive as they're working through these programs. So that would be the biggest thing. It's policies, procedures, and making sure that everyone's trained on how to use them.
So Jennifer, if you could conclude for us with how community and public health partnerships can help to ensure equitable protections for populations. And maybe you can comment in that context also of how we collaborate through a grant that we have as the Public Health Department called the BRACE Grant that we partner with Yale on specifically to address some of those comments. So.
Yeah, thanks for bringing that up. So just to start with that, you know, right here in Connecticut, through this BRACE grant, which stands for Building Resilience Against Climate Effects, it's a CDC framework. Yes, the CDC Climate and Health Program still exists. And yes, we did just get our grant renewal. So we are really looking forward to doing the outreach in our final sprint, working with local health departments in Connecticut around their heat and air quality response planning, and really looking at those together because some of the responses are they're overlapping, right? So like when there's an extreme heat event or an air quality event, then you know the traditional solution for heat was and it still is cooling centers. We know that sometimes those are not very well attended, if at all. And they're not necessarily in community spaces. And so one of the mini grantees, they've been looking at building these resilience hubs where it's a community space where everybody is, you know, already like meeting people where they are, they're comfortable, it's very inclusive and accessible, and kind of really listening to and elevating community voices that way. It's, you know, doing like hyper-local air quality or heat monitoring in certain communities to identify those hotspots where there's larger degrees of exposure and really targeting interventions that way. So we're also developing a toolkit so that, you know, not just the pilot grantees, but other health departments around the state, you know, Connecticut, we have like 60 health departments, to be able to benefit from some of these best practices that we've compiled from around the country. I know there's more work that your staff is doing around just like the capacity building and getting data from, you know, from the State Department of Health to be able to look at, you know, what that looks like in, you know, extreme heat and hospital admissions, and making that and just building awareness around that, I think is critical. And then a couple weeks ago, we convened a, you know, well-attended symposium on climate change and health in Connecticut. So even in our small state, you know, I think there's a lot of interest. So more work to be done on that. I think I'm so glad that Commissioner Grant mentioned creative partnerships. So like one of the things that I know for like these wildfire smoke events is that like indoor air filtration is so important, and these can be made very cheaply, or you can buy one, you know, for, you know, a decent amount of money, but like middle and higher income households can afford them. But some of the households that have sort of poorer or older housing quality and don't have air conditioning and have to have their windows open, do not have access to this kind of very basic technology that can really reduce their exposure. N95 masks are a very simple and cheap intervention around protecting oneself from PM 2.5 smoke. Are there ways that, you know, can be just like through employer programs that this kind of stuff can be done? Again, like thinking about the longer term benefits. I thought of a creative partnership. This does not involve the insurance industry, but I was thinking about New York City Department of Housing sort of did like a design competition for induction stoves because those are, you know, have been quite expensive. And so leveraging their economy of scale in public housing, they're, you know, encouraging people to create a cheaper induction stove that then can be deployed and really, you know, helping reduce that indoor air pollution and reduce greenhouse gas emissions. I would be remiss to not say something about greenhouse gas emissions. I know that may be the elephant in the room, but we are at a climate risk conference. And I think that for me is the mitigation. I know there's other definitions of mitigation. And I know insurance, there's like, on this like the risk management side, it's different than like, you know, investments. But I do think as in the insurance industry, as health professionals, as the health department and the housing department, I think there is a role to look at and to call into question the idea that we can't do anything on the climate mitigation side of things. I think the more that we can talk about these effects and the costs to health, to our economy, to businesses, and to, you know, economic prosperity, I think that really hopefully helps strengthen the case for action on climate mitigation. So I will just leave it at that.
Thank you for that, and I think you do nail it on the head, because part of what we do in public health is educate. That's actually what we do a lot of. It's probably 50% of what we do, I feel. And to the point on reducing greenhouse gas emissions, we were on a panel, Jennifer and I, last week for Climate Week, where I talked about Revolution Wind and the fact that that project with windmills in the Long Island Sound, $5 billion invested into it, 80% of the work done, was shut down because the federal government decided to cut $550 million left, and through a lot of collaborative efforts and the administration suing, and the project is off and running again. And so again, if we can talk about these things, we don't know if that's the conclusion and if it'll get done, but we hope so. That is going to have tremendous health impacts in terms of our state. 350,000 people in the state of Connecticut will be able to get wind energy. That is going to drive down greenhouse gas emissions. So we have to continue talking about it to potentially be able to also help influence those other levers that we don't necessarily have directly in the health department. So I'm going to take the privilege as the moderator for the first question here, since it seems to be directed mostly at me, which is, does the public health department have a heat map of the state showing places where asthma and other environmental health conditions exist, just like we do for floods? And what I would say is, part of that is the work that we've been working on and developing a little bit of for the state and collaborating with Yale on. I would also say that in general, if you think of our cities, when there's a heat wave, Connecticut's a pretty small state. In general, the areas that have less shade, less cover, more factories, we tend to see the heat impacts greater in those areas. But we've seen that also in, so the valley area. There are areas where the air quality is bad based on, different factories that may be out there. And so that's part of what we're continuing to work on and develop. I want to go to the group, and anybody can feel free to take this question. What opportunities do you see for different groups to collaborate and help fill the gaps in climate change health impacts? Anybody want to take that?
I'll start. I mean, basically, I think having multidisciplinary approach, getting the different perspectives in the room, really understanding and expanding from a standard cost-benefit analysis, effectiveness to a value proposition. So if you have employers in the room or you have other interests, they can look at what their preferences are. I think we need to understand that there are different ways to approach and address each of these issues as they come to us. The other part of this is bringing economists in. I have study groups with economists all the time to help me figure out, as we expand and talk about value propositions, looking at what's the process and effort for doing this. Is there a different way to do this that's more efficient, less costly, less of a process issue? I think those minds have to be at the table as well. And obviously I'd bring in prevention services, so risk engineering, so the industrial hygienists, the ergonomists, all those that are out there that can help with regard to preventing the illnesses as opposed to trying to deal with them after the fact.
I think we need more diversity in the conversation. I think a lot of us were at Climate Week last week, bigger than ever before, incredibly energizing, but sometimes it feels like we're with slightly different panels and the same topic of conversation. And I was really excited to see more and more kind of truly cross-industry, cross-sector conversations happening. How does food and nutrition relate to the environment, relate to health? What's the role of innovation in universities and technology in solving some of these? But I think we've got to get comfortable inserting health and using health as a lever into broader conversations and avoiding the comfort that I think sometimes comes with this space.
I would love to, I would love to just quickly piggyback on that with the diversity comment. And I was just thinking about, like even within Connecticut, it's quite, there's different pockets of diversity. So we have like quite well-off suburbs in some cases, and then we have like some of our cities that really struggle with climate impacts and then all these layered environmental harms and environmental racism through decades of housing policy and economic policy. And those voices are really important because I think they obviously are seeing firsthand what the issues are, and they're also going to be able to know what's going to work and what's not going to work, and also who do they trust in order to learn about, to even just like gain the information. I don't know that Yale, we've been trying to, be really collaborative with communities, but there's still a little bit of that, you guys are ivory tower, who are they going to listen to? Oftentimes it's community leaders, it's faith organizations, right? It's like they're, doctors and nurses, and other trusted groups community groups, community health workers. So who are the front lines in working with these kind of, quote unquote vulnerable populations? Because oftentimes you'll find that they're vulnerable only because of their circumstance, but oftentimes there's a lot of great ideas, they have agency, and I think they should be a vital partner in a lot of this, looking at the solutions.
Yeah. David, maybe you can take this question. What could the role for nonprofit health systems and hospital community investments be in driving investment in healthy communities? And do you think that they are under-leveraged?
I think they're under pressure. I think there's a lot of pressure facing the provider sector, especially the nonprofit one at the moment. And I think it's a continuing challenge to get people to recognize that this is a clear and present threat in the face of a lot of other things that feel like clear and present threats. But you go back to, and I think you mentioned this on the academic point earlier, oftentimes, the nonprofit health center is the largest employer in the community. They're often at the front lines of seeing the impacts of this issue up close and personal, and their providers are deeply connected to the community. So I certainly do think there's a greater role to play. And I also think it's an area where more collaboration is an exciting opportunity. And I think there's a lot of room to come together. There's already wonderful coalitions. There's an insurers working group that Healthcare Without Harm sponsors. There's similar things with the Healthcare Anchor Network on the AMC and on the hospital side. But I do think coming together, and back to the data point, again, like we're sitting on loads of great information from the community health needs assessment processes that they all have to do every 3 years. Like we're not leveraging that enough to drive the change that we need.
Can I respond to that
Sure,
just quickly? To give a little plug for Maryland, because we actually have a unique all-payer hospital model where I think it's not perfect, but there's still plenty of important work to do, but the incentives are changed. Our hospitals are paid by global budgets, and so that they are rowing more in the same direction as insurers, I think, than in other places. And so that, not easier said than done, but that is one way to.
Many of us envy what you have in Maryland. I will not deny that. Maybe you can also comment on a potential role for insurers in covering access to, it says here nature prescriptions, but maybe it means natural prescriptions also, as part of a holistic approach to conservation, or nature prescriptions, I guess.
Oh,
actually.
I'm forgetting the term, but like going for a hike.
Yes,
right?
I think so.
Nature
I think
bathing.
That's how I take it. Yeah.
Yeah, that's a great question. I do think, again, to this conversation, the role of insurers, encouraging insurers to be more creative about all of these kinds of things, that's a great example. But it's also an example where sometimes an insurer's role may be to just outreach and education, right? They do have access. They're going to be one voice. They might not always be the most trusted voice. But I do think our insurers, some of whom have been very creative already, can play a greater role in that kind of thing.
And I'm going to have our last question go to Adam. Adam, if you could take this one. Are there policies physicians or hospitals can advocate for or ways to partner with insurers?
Absolutely. I think the conversation needs to continue. I mean, we do have different avenues of connecting, but sitting down, one of the things I'll say is, you know, the reimbursement system in the US, I think we need to look at it a little bit differently. A fee for service, you heard about the global payment. I think it was Pennsylvania and Maryland that CMS saw huge savings based on that and just said, you're responsible, the hospital system, you're responsible for all these people in your catchment area. And they came up with all sorts of systems and abilities to take care of those people. So we need to, you know, really expand our bundled services is one way, but there's other things out there as well. So outcomes and other measures, I think that would be where the best conversation would have, is not just understanding the data that we need, the quality, the fact that they need to use these specific codes when they are available, but also how they're going to get paid for certain activities and not be at risk. You know, there is some risk in some of these models, but most of the time we can work beyond it so that the health system, the doctors are still able to cover all their costs and be profitable.
So I think with that, we will wrap up this session. I want to thank all of our panelists for really bringing forward different perspectives and views into this really interesting conversation. I think we can all take from this that we all register what's happening with our climate and in our environment to directly impact the health of people who are insured by plans, that we know we are currently in an environment where there may not be specific moves from the federal government to necessarily support climate work per se, but there is an opportunity and there is agency that we all have to be able to recognize the challenge that we have. And I think what you've heard from all our panelists is there's an opportunity to collaborate, to have people from different sectors come forward in this conversation. I think this panel is a perfect example of that. And from people from all different views of life who are all working to a common goal. And to me, that is something that we can be hopeful about and think about how we can continue to do this work better as we move forward. So thank you very much for listening to us today.
Well done.
Thank you so much once again to the panelists for a really fascinating conversation on reshaping the health impact of climate change and insurance solutions. At this time, we'll transition a bit. Before our next lightning round, I'd like to introduce a speaker for some remarks. He is the chair of CTIFS's board, the president of Connecticut, and the CCI plan president for Connecticut at Molina Healthcare. Please welcome to the stage Mark Meter.
So good afternoon, everybody. I know it's been a great session so far. And the other day, I was talking to my wife, and she asked me, what is this CTIFS group that you're a part of? And I tried to explain to her that it's not the CTIFS, it's CTIFS. But as you can see, you know, once you look at it, you'll never forget it. So that's the way she thinks it's spelled. But in fact, for 2025, CTIFS has been around for 22 years and as a board of directors. And I've been chair for 1 year. We are a unique group of 23 senior leaders managing P&C, life, retirement, health insurance, and financial services businesses alongside our service provider partners. When we walk into the boardroom, we leave our competitive hats at the door and act as one unified voice for the Connecticut insurance and financial services industry. Our milestones have been many throughout the years, but we have had direct impact on two strategic priorities. One is retaining our young talent in Connecticut, and two is raising the profile of the Connecticut Insurance Capital brand so that Connecticut is rightfully recognized as a global center for insurance excellence. And now, after Commissioner Mays' comments, an intergalactic center of excellence. So both of those goals, I think, have been accomplished today. We have had deep content that you've been exposed to on climate awareness and resiliency, and the young talent in this audience, I hope, are eager to learn and carry the mission forward. And speaking of going forward, our board will remain a unified voice for the IFS industry in Connecticut, committed to advancing and strengthening the industry and in supporting jobs and economic growth for one of Connecticut's most important industries. One of the key board members of the Connecticut IFS team is the Conning Company, who for the second year has co-authored and co-published the Connecticut Insurance Insights Report, Capital Insights Report. And I personally want to thank Scott Hawkins, Manu Mazumdar, Lauren Koth-Avale for making the report a reality. The report outlines what we can achieve if we are committed, what climate change risks we can mitigate if we invest, and what we can do if we grow talent in Connecticut. So maybe my wife is right, and when she calls us the Connecticut IFs. So I'd like to now introduce Scott Hawkins of Conning. Scott is a managing director and head of insurance research, responsible for producing research and strategic studies related to the insurance industry. Prior to joining Conning in 2006, he was Senior Research Fellow for Networks Financial Institute at Indiana State University. Previously, he spent 16 years at Skandia Insurance Group in the US and Sweden as analyst and senior researcher. He studied history at Yale, has a certificate in information management systems from Columbia University, and was a board member of the J.M. Huber Institute for Learning in Organizations at Teachers College. Scott, the podium's yours.
Thanks, Mark. Can everybody hear me okay? I've been accused of having a very soft voice. I just want to make sure everybody can hear me well. You know, I've had the privilege of representing Conning at many conferences over my years with Conning. Some of them are insurance conferences, some of them are technology conferences. And over that time, I've noticed there's really two distinct dress codes depending upon the conference. If it's an insurance conference, you're going to be wearing a blazer of some sort. If it's a tech conference, it's either going to be a black t-shirt or a puffy vest. Now, this conference always blends those two topics together. So since I don't own a black t-shirt, I've blended the puffy vest and the blue blazer. Now, for those of you who are not familiar with Conning, we've been a proud member of the Hartford and Connecticut business community since 1912. Our focus is serving the insurance industry, primarily through asset management. We manage $175 billion of insurance company general account assets in the US and Europe. But we also provide risk management solutions, insurance accounting, and the group I head up, which is insurance research. As Mark said, we produce high-level tactical and strategic research that insurance companies and other insurance service providers use to manage and run their business. And our focus is on what drives profitability for this business today and over the next 3 to 5 years. And within all these publications that we do, and we do about 170 a year, we organize them around broad themes. 2 of them are climate risk and its impact on the P&C industry, and technology and its broad impact across the board. As Mark said, this is the second year we've partnered with CTIFS and Metro Hartford Alliance to present the Insurance Insights Report. It's being released today, and I believe if you scan the QR code, you should be able to get to the link and download it. It's my privilege to be able to introduce it to all of you this year. I also want to extend my own personal thanks to Susan, Jean Goddard, the CTIFS board, and then Metro Hartford Alliance, and everyone else who participated in producing this report. And my own personal thanks as well to the team of Manu, Lauren, and Lauren, the two Laurens, I call them, Lauren Cavalli and Lauren Savini, who on my team helped actually produce this report. So speaking of my team, one of the things I always ask my analysts, whenever they're going to propose a topic and write a report on something, I ask them, why does the reader care about that? Why should they spend some of their time looking through a report that you've invested time and effort in producing? I hold the same for this report as well. I think there are 3 different reasons why you may want to consider looking at this report and actually reading through it. First, if you are in this state and you're in the insurance industry already, this report will give you a good snapshot of how this state is investing in this industry and providing for its future growth. Second group, if you are considering moving to this state or starting a business in the state in the insurance industry, it does a similar thing. It gives you a sense of how well this state is committed to producing and promoting the insurance industry. And third, if you're in another state who has an insurance industry, and there's 49 of those, you'll get a sense of what it takes to remain at the forefront of the insurance industry by understanding what Connecticut is doing. Now, with that in mind, what are some of the highlights that you will see in this year's report? Well, first of all, as in last year's report, you'll see some of the reasons that Connecticut's insurance leaders say this is a great state to conduct insurance business in. There will be interviews with Commissioner Mays, Commissioner Koski, who will provide insights on how the Connecticut Insurance Department and the NAIC are supporting the insurance industry in this state, not only in terms of supporting innovation, but dealing with regulations and dealing with the issues of climate change. Now, I want a quick show of hands, and this is not just to see who's still awake at this point. How many of you know that this state's motto, nickname, is the Nutmeg State? Raise your hands. Yeah, not many, okay, but enough. I was driving back from a vacation in Cape Cod yesterday, and as I crossed the state line, I saw a sign that had another state motto. How many of you know that it's now Connecticut, the submarine capital of the world? Raise your hands. Now we're in Hartford, and Yukon's not that far away. How many of you know that it is Connecticut, the basketball capital of the world? And of course, I'm an old New Haven guy, so how many of you know that it is Connecticut, the pizza capital of the world? Well deserved on that one. Now I'll ask this. How many of you know that now Connecticut is the intergalactic insurance capital of the world? I want to highlight a couple of examples of why we have that a nickname, the insurance capital of the galaxy. We lead the nation when it comes to insurer employment as a percentage of the overall workforce. We employ over 56,000 people in this state's insurance industry that come to work every day in our companies. Connecticut domiciled insurers wrote $212 billion of direct premium in combined P&C, life, annuity, and health premiums last year. This report goes beyond those numbers. It touches on 3 areas that we think can show our commitment to continuing to develop and support this insurance industry. First, you'll read about the Connecticut UK Insurance Corridor, which is actively bringing insurtech startups from the UK to Connecticut. Now, this is an exciting partnership between the UK Department of Business and Trade, CTIFS, and Metro Hartford Alliance, and is part of the broader framework of the US-UK Financial Innovation Partnership. In the last year, we brought 4 companies from the UK, introduced them into the US market through that corridor. However, the corridor is not just about bringing UK businesses here. It's also about helping US businesses find opportunity to grow or enter the UK market. To that end, earlier this year, the UK Department of Business and Trade hosted an international trade delegation for Connecticut insurance companies to come and learn about that market and identify opportunities in that space. Second, while our neighbors to the north and to the south do have some very strong educational programs, I would have to say that Connecticut's world-class university-level insurance and risk management programs are helping lay the foundation for the next generation of insurance professionals needed to keep driving this state's businesses forward. I'll give you one example around actuaries, and there's a greater depth analysis of that in the report. You know, actuaries are the lifeblood of the industry. I will make no actuary jokes in honor of all the actuaries that might be in the room, but we have over 1,300 actuaries working in insurance companies in Connecticut. But we can't rest on those 1,300. They will eventually retire. So this last summer was the 17th annual actuarial boot camp hosted here in Hartford. That continues to give high school students an opportunity to learn about the opportunities to become an actuary and enter that great field. During that week-long program, they heard from over 20 presentations from actuaries in Connecticut insurance companies. They heard from the CID. They heard from InsurTechs about what it was like working in the insurance business. They also took a one-week course in college-level probability. Those are trying to entice high school students to enter our business. It's the workforce of the future, and we're investing in it. Finally, in returning to the broader themes of this conference, Connecticut's insurers continue to adapt to climate risk and provide better coverage to their customers, as well as faster service. And here's where today's major themes of climate management and technology start to merge. With policyholders spread across multiple perils and geographies across this nation, Connecticut companies have embraced advanced technologies and predictive analytics, not just as a response mechanism, but also, as our report found earlier this year, they're using these to enhance operational efficiency, customer service, and underwriting profitability for people that are suffering from natural catastrophes and getting claims paid faster to them. Great report we produced. See us, and we'll be glad to share that with you. So, on behalf of all of us, and I am in the lightning round, we hope you find this report very, very informative and helpful as you consider what the state is doing to build an insurance industry today, tomorrow, and well into the future. And should you have any questions about the report or the issues affecting the broader insurance industry in this state or beyond, please feel free to reach out to me or Susan or anyone from the CTIFS board, and we'll be glad to help you out. And I want to thank you with that. Enjoy the report and enjoy the rest of the conference. Thank you.
Thank you very much, Scott. Appreciate those insights. We're going to move now into our last panel conversation of the afternoon. This conversation is going to revolve around innovative insurance solutions for climate resilience. We're going to take a look at cutting-edge insurance strategies for climate adaptation. Moderating this conversation along with his fellow panel members is Craig Weber, the head of insurance strategy at Cognizant. Please welcome the panel and Craig Weber.
You heard the magic words, last panel. Now, I have it on authority from the organizers. They're going to not set up the bar until they see how this goes. So there's a lot of pressure on this team. I'm Craig Weber, head of insurance strategy from Cognizant. Really delighted to be with you here. And really, some really interesting themes have come out today. Kind of surprising to me just to hear how this is all played out. So we're going to serve as the anchor leg of a very, very interesting day. And I'm joined here by a great panel. Just to frame this before I introduce the gentleman here, one of the ahas I've had is that we all believe in this room in the mission of insurance. And that to me is sort of an interesting, almost astonishing thing to have regulators and insurers and reinsurers and tech folks all here to kind of do the same thing. One problem with our industry is that we don't always get credit for the amazing societal good that we do. And so what I want to do is just maybe highlight in some of our comments today some of the ways in which we think we're doing a good job today and ways we can do more with innovation and technology. So that's our task. I'll throw it to the team and stop talking so we can get to that bar and see if they set it up for us. We're going to talk a lot about technology. We'll talk I've heard mention of parametric insurance, other technology models. We'll probably get into some of those. But let's just see what our panelists can come up with to kind of tie a bow around the other themes that we've heard from today. So in the next session here, let's open this up to the panel. I'm going to have them introduce themselves, but I'm delighted to be joined by William Brock-Long, the former administrator from FEMA, and Haggerty Consulting, Marcus Schmalbach from RiskX, Raghavir Binakulu, who from Munich Re, welcome, and Peter Brickwetty from Minnesota Department of Insurance. Now, let's just join them. Let's give them one boost of energy before we kick off and say thank you to our panelists. All right, there are no excuses now. You had your energy. Let's get going. Maybe just give one quick minute intro to yourself so we can understand kind of where you're coming from.
Sure. Good afternoon, everyone, and thanks, Greg. My name is Raghavir Binakulu. I am the head of Climate Insights and Advisory. If you want to know how important it is, just take the initials. It's the head of CIA. Right, just kidding. Yeah, basically, I sit within the reinsurance division of Munich Re, the reinsurance company, really focusing on the impacts of climate risk and how does that impact in terms of the future solutions. So that's the reason why this is where I sit. I'm not sitting in the corporate team. I'm sitting within the business team, really working with our clients, with the cities, with the communities, really to think about one hypothesis question that we started with: what is the insurance industry going to look like in 10 years from now? So,
perfect frame. Marcus.
Yeah, hi everybody. Marcus Schmalbach. I'm the founder and CEO of RiskX, which stands for Risk Exchange. So we are more likely still a startup, 8 years old. We started our journey in London. We are based in the Lloyd's building, 4th floor. So whenever you are there, please say hi. And we are linked with Connecticut now for more likely 3 years. We found a home here for our PCC structure. Means we are also working in the captive space. We are, yeah, as I said, an insurtech, so you will hear a lot of buzzwords from me today. AI, blockchain, parametric, that's what we are taking care of. And yeah, what more to say? In my second life, I'm a professor in Paris and Berlin, so I'm coming from Europe. And I'm a professor for blockchain and AI with a major focus on influences on the finance and insurance industry.
You're welcome to bring up the Ryder Cup if you must.
Congrats. I didn't say it loud, but I wear the old shoes of Rory McIlroy. So,
very nice, very nice.
Just to let
William.
Hi, I'm Brock Long. I'm a recovering FEMA administrator. I've spent 26 years cleaning up disasters, and I think every time I changed jobs in my career, something catastrophic happened. It was funny, the nation went from 2005, Hurricane Wilma was the last major landfalling hurricane. We go 12 years until I get appointed to be head of FEMA in 2017. So if you think about it, you know, the nation goes 12 years without a major landfalling hurricane from 2005 to 2017. I go into office and get hit with Harvey, Irma, Maria, the California wildfires, Hurricane U2 in the Western Pacific, Hurricane Michael, Florence, all of them. And if you add it up, it was 220 disasters and wildfires in 2 years, one every 3 days. And if you add up all the recovery dollars to go fix the communities, as a result of those events, it was more money than the 9 previous FEMA administrators before me combined. We have a broken business model in this country when it comes to disasters. And I'm also part owner of a minor league soccer team, which is a lot more fun than disasters. Thank you.
Hi, everybody. I'm Peter Brickwetty. I'm Senior Director of Insurance Sustainability and Climate at the Minnesota Department of Commerce. None of those words, well, maybe one of them helps you understand what we do in the state of Minnesota. We're the state's insurance regulator. We also do financial services, which is common for some insurance counterparts. But we also have the state's energy offices, along with 40 different industries across the state of Minnesota. So we see a large swath of the white-collar economy in our state in particular. And my job is to help make sure that we have a stable, affordable, and accessible insurance market, particularly in the homeowner space. So looking forward to the conversation.
All right, let's kick things off with a little buzzword bingo. We'll call this session, I'm going to give them a little bit of a name, Technology and Innovation for the Win, let's call it. And yes, this does correspond to what we talked about, but I've just put a cute little name on it just to wake the crowd up a little bit. Marcus, we'll start with you because you mentioned technology. Talk to us about technology, the technologies that you mentioned, and where you think they fit in the climate resilience story.
Yeah, as I already mentioned, I'm working in this blockchain AI sector. When we started 8 years ago, the blockchain bubble was up, and we decided to bring that into the insurance industry. So if you are still not familiar with the blockchain, it's an accounting system. At the end of the day, it's an accounting book, nothing more. But it's very attractive if we talk about, maybe you've heard about smart contracts one day. It's an opportunity to execute claims very fast, very quickly. So this is why we adopted this idea. And the overall idea, I should say, is more likely from us to say, when we talk about climate resilience, that we would love to expand the ILS market as well, means the insurance-linked security market. Just to drop a number, the finance sector is 15,000 times the reinsurance market, which makes it very attractive, and which means that we see potential to sell risk as an asset class to the financial sector as well, to support the work in the insurance industry, which is tremendously good. But what we've seen in the early stages, that the financial market, or hedge funds, ILS funds, whatever, they are not familiar with our vocabulary, and they do not understand this indemnity thing too much. So we ended up with parametric, or better say parametric 2.0, because we are big fans of not having just one single trigger as a solution, but using 2 or 3 as more likely a trigger chain. And the idea behind that is really to open our exchange for the financial sector to invest in traditional insurance risks. So this is the overall idea, and as said, the blockchain helps us to execute that in a very quick and safe and secure way. And on the other hand, I definitely need to drop AI as well. We talked a lot about new data and climate resilience and so on. So we use AI to not underwrite in a more traditional backward-oriented way, but more likely in a prediction way. So making use of every single data which is acceptable or available, then you have to find out what data is really acceptable for your structure. And then the AI helps to make a prediction, more likely to say, okay, how will the hurricane season, for example, affect us in the next year, and not looking backward-oriented and say, okay, last year we got hit really high, so we have to ask for higher premiums, more likely using AI to say, okay, what will be the real pricing in the next year and the near future, as soon as this is where AI can help you to make predictions on that, and less underwriting perspective, backward-oriented.
Yeah, what's interesting, if I extract what you just said a little bit, as an insurtech, you're taking some interesting technology and challenging some of the conventional wisdom and approaches that the industry has taken.
Yeah, sometimes it's seen like that, but we are definitely not an enemy to the traditional industry.
I wouldn't say challenge in a bad way.
No, I got you. Sometimes I love that when I've been here on a conference before, the commissioner called it frenemies. And did not hear that before, but that's really interesting, because somehow we are seen as exactly this. But it's really, I'm your friend, I'm not your enemy. It's more likely what we do is maybe in the first instance a bit confusing, and I fully understand that. And this is, as an insurtech, it's always about who is sitting in front of you. If you have to pitch it to investors, you have to drop the whole storyline up and down, and drop AI 5 times and blockchain 10 times, and building the big picture. If you have people like us coming from the industry itself, you will demystify that it's a lot of bullshit bingo. So what I'm saying is differently, but what I'm saying is that technology is also our friend and we can all make use of it, and it should help us by what we are really all try to do is building resilience and helping our clients with products and solutions. And so we are the guys who focus on the tech track, I would call it that way.
Raghu, from an reinsurer's perspective, you want to weigh in on that take?
Sure. Well, we're friends.
We are definitely.
What I wanted to cover is, I think, in terms of, let me start by saying we just came from the Climate Week. It was last week, Climate Week in New York City. And one of the things that came out of this 1 week, at least what I synthesized from it, is there is nothing like climate change is going to happen. The question and the answer is very clear. It's here, right? So the risk is here. And let's just put some perspective on that. Just from 2018 to 2024, the amount of losses from wildfire in the United States has been $90 billion, right? $90 billion. And that's insured losses. That's not the economic losses. So I'm only going to specifically speak on insured losses. Now, within that same time frame, the amount of homeowners premium collected in the state of California, where the most exposure and most losses from wildfire happened, that was about $75 billion in that time frame. So in terms of, again, homeowners premium covering a lot more than wildfire, is the wildfire market sustainable? That's a big question that the industry has to constantly think about. So what's really happening behind the scenes when we talk about new products and from a reinsurance or an insurance company is we're constantly thinking about the word risk transfer continuum. Insurance does not sound good. It may sound boring for a lot of people, but what's really a cool word to use is risk transfer. So the risk transfer continuum is what I would like to use. It has 3 concepts in it, which is risk communication first, or the assessment of risk. If we have to solve it, we really have to understand the risk. And then it comes to the risk management part of it, which is the risk mitigation, and then comes the risk transfer. So risk transfer, for it to be sustainable, the first 2 parts have to be addressed. And that's really what is the concept of the industry continually working on. And from an innovation standpoint, that's what we are trying to address. United States is the single biggest insurance market, by far. Any company any global insurer you talk to, ask them what their share is of the United States as compared to the rest. It's generally at least 1/3. That's how big the United States market is. But at the same time, we also understand there is a lot of coverage gaps. So from that standpoint, we are looking at some of these insurance solutions that can provide more complementary solutions, and how do we address risk mitigation? Because ultimately, we also have to understand that we cannot change the market overnight. We cannot ask homeowners to change their way of thinking and invest $30,000, $50,000 in risk mitigation. That's not going to happen overnight. So we have to think about community solutions, and that's what we are really looking into. How do we work with the mayors or the community managers or the town managers and really address some community solutions? So one example I like to give is the city of Ileton in California. They just placed a community parametric solution where the community of 500 homes put together there, and they took an insurance solution which pays out about $5,000 right after a flood event happens. So those are the kind of, again, I'm really focusing on that. It's really innovation with the basics involved within the insurance industry, which is, again, the risk transfer continuum.
Interesting, like social construct difference. If you ask people if they want to belong to an HOA and pay into it and get a new road out of it and new mailboxes, they would understand that.
Right.
But they wouldn't necessarily bite on the insured loss piece.
Exactly.
Yeah, that's very interesting. Brock or Peter, do you want to jump in on this question?
I think innovation is important, and we have to have it in the system. I think it's really hard for state regulators to keep up. And I think trying to stay moving at the pace that the innovation is occurring requires a lot of prioritization. It requires decision making. I think it is going to require a continual sort of reinvention of how we staff in insurance departments and evolving that model. I think having a consumer-first orientation through all of that, I think is going to be really important. One of the best things about being on the last panel of the day is everything that you thought you were going to say has already been said by somebody smarter on the panels that have already happened. But it's great because I think one of the points that we've heard a lot about today is how do we think about products that help people stay healthier, stay safer in their homes, in the places where they do business. And can we do that in a way that actually saves them some money? Because people are starting to think about insurance in a way that they really have not, because it's becoming more increasingly a pocketbook issue around kitchen tables, around business tables, and figuring out how we can use some of the technology, some of this innovation to help accelerate the pace of that increasing of health, increasing of safety, and hopefully increasing saving of money so we have insurance that is affordable and accessible will help both us and state departments keep up with that and make sure we're moving at the pace of innovation, but also hopefully prevent the economic and personal costs of increased disasters having impacts in our communities.
Yeah, I don't want to put you on the spot, Peter, but I will anyway.
That's what I'm here for. Yeah.
So did I oversell the sense of collaboration that the regulators and state and local governments and commercial side of insurance have?
I think I'm a business unit of one. The state of Minnesota, we're about the 17th to 18th largest market in the country, sort of bigger than our population size. We don't really have a relationship with the reinsurance industry, for example. What we have is a great interest, but and we have really good dialogue and exchange, and there's really specific projects that I think we could talk about here. But we don't have a regulatory relationship because we don't regulate the reinsurance industry. We don't regulate insurtech. And so I think it's a different level of creative thinking for state regulators to have to get into. And I think some departments have really done this. You've started to see states start to build out business units that really are focused on climate, really focused on data analysis, and trying to interact with these other enormously important market players that historically state insurance regulators really haven't interacted with at a big level. So I don't think you've overstated it, but I think it's a relationship that's new and needs to get increased in its capacity pretty quickly.
Conversation going, let's keep it wound up is what I'm hearing. Yeah. Let's talk about getting back to business as usual after an event. And Brock, I'm gonna look to you, I think, partly on this. Raghu mentioned some coverage gaps. You know, we're all familiar with some of the major disasters you described, some recently this year. Even in my neighborhood, I live in San Antonio. I'm about an hour's drive from the Kerrville floods, 135 people dead, tens of billions of dollars in economic impact. What happens? What can we do that is innovative and interesting to get back to business as usual, to get people back in their homes, to get recovered?
You know, I've been bogged down in the FEMA reform conversations. I've testified twice in the field, once in New Orleans, and then last week in Asheville about FEMA reforms. One, I think if we're just focused on reforming FEMA, well, then that's too narrow of a focus period, because we've tried reforming FEMA multiple times, once after Andrew, once after Katrina, once after Sandy, the DRA. We keep strapping shiny parts to a rusty bicycle when the entire business model needs to change. And I think one of the things that you need to understand is that FEMA's most expensive expenditure over time is uninsured public facilities. Wait a minute, what? A lot of people have no idea that the way you get a disaster declaration after all the life safety stuff has taken place is that the emergency managers go out with public works officials, and what do they start looking for? Uninsured public infrastructure losses. And so the whole system was set up in 1979. And essentially what happened is that somebody thought it was smart, let's connect $1 to every person's head in America. So whatever the population of Connecticut is times $1, if you can go out and find roughly $3 million of uninsured public infrastructure, you're going to get a presidential disaster declaration. A lot of people don't understand that, right? It's woefully low. And for FEMA to kick out $3 million, it costs them more in overhead to actually just cut the check.
That's one bridge,
to administer it, right?
or something.
So as we go through reform, one, the disaster declaration process has got to change completely. And we have to start rewarding communities that do, states that do land use planning, building codes, and ensuring their public infrastructure. And I think that the states that do that should have greater access to education DOT grants. You know, we've got to start providing those or paying less of a cost share when they need the federal government to come in and help backstop some of the losses. Right now, my greatest concern too, and going back to the rag of ears probably going to hit me in the back of the head because I think we focus too much on risk analysis, okay? What do I mean by that? How many times do we sit in a room and start to figure out what's got to be working in your community that if it's not working, people are dying or life routine is disrupted? What are those things? That's your hospitals, that's your transportation systems, that's your power, that's your fuel, that's your bulk water systems. So we can try to sit around and game everything that's going to go wrong in this country. I mean, who knew a ship was going to lose its steering currents and knock out some bridge in Baltimore? Or, you know, foreign state actors were going to take out the Colonial Pipeline for kicks and giggles. We can try to sit around and figure out what goes wrong, but we don't spend enough time on what's got to be working. And then if we identify what's got to be working, we have to identify who owns it and how the federal government can actually help them from ever going down or coming back up when they go down, right? And we better start figuring out mitigation programs. So I was proud of the BRIC program that was created underneath my leadership, the Building Resilient Infrastructure in Communities. But the whole purpose of that program was to identify what we call community lifelines, the things that have to be working in your community. Then we better be focusing our mitigation dollars on that in the future. So who cares what happens? What we care about is that this infrastructure we need is still working so that, you know, communities can go on and be viable. It's just a different way of thinking about it.
Gregor, you want to come in on that?
Yeah, no, I think Brock hit on quite a few points, but like to the earlier point which you asked Peter also, I just wanted to address that there is a really nice paper by Climate Policy Initiative called Building Climate Resilience for Cities, along with the insurance industry, right? And that's really one place where the industry can help, and we have continuously worked with many communities and cities to perform these benefit cost analysis whenever there is any kind of major infrastructure changes that Brock was mentioning about. These are places where the insurance industry can actually opine on what would the impact be. Absolutely, the first focus should be on saving the lives of people. But if that second goal can be that what would the impact of the insurability of that community would be, I think that would be a long way we could go. And the insurance industry, including Munich Re and others, we have continuously done even pro bono work, but also consulting work in terms of working with these cities, even though that's not our business model, but we do do that. So in terms of, some other questions and topics that we think about is we as a society, and this also came up from last week from Climate Week, is we are supporting lots of technology in terms of addressing climate change. But what really we are missing out is something that we all see every single day. And that infrastructure is our own green infrastructure, right? Which is nature, trees, and so on. There is so much over the Mississippi River that there are lots of conservation companies that are working towards in how an afforestation project or a wetland restoration can address not just the mitigation aspect of climate change, but also the adaptation aspect. And Munich Re, actually, we partnered with, and there's something that we have presented to the NAIC as well and others, how, along with the Nature Conservancy, how a levee setback, which is a nature-based solution, just a little bit of rethinking and working with the Army Corps of Engineers, how that could reduce the premiums of flood insurance over these communities by almost 65%. And so these are projects that we are continuously thinking about, and we would love to keep that collaboration on.
If I may add to the other disturbing aspect that I always see after disasters, and let's take Hurricane Helene in North Carolina, for example. I think our public awareness campaigns I would like to see a stronger public awareness campaign between emergency management and the insurance industry, right? I think that we need partnerships and real partnerships. And here's the thing, it seems like for decades we've been telling people to go out and buy supplies, buy 5 days worth of supplies and a kit and a generator and all this stuff. It's an unrealistic financial ask, not just because of income poverty, but also asset poverty. You know, I don't have 3 months worth of savings to my name. I think I'll cut back on insurance to afford my lifestyle. And a lot of that's what's going on. And we will see this in the data, at least at FEMA, where we got to stop telling people to go buy supplies for 5 days. I'd rather them sit down and take that money and be properly insured. And I actually joke that, you know, nobody's ever starved to death in this country after a disaster. Never seen it happen, right? But what I just saw in my home state of North Carolina is 160,000 disaster victims, uninsured or underinsured. So how are we telling people to be ready? And instead of being ready for 5 days, we need to start teaching people how to be ready for life, the tangible skills that go on. You know, you can graduate universities and still not know how to do CPR, invest $1 in the stock market, right? And so a lot of people will cut back and try to save money on insurance, when that's the worst thing that they should be doing and trying to save money in their budgets, in my opinion. So I would like to see stronger campaigns that make sense. And even with flood insurance, stop worrying about the map so much. Any house can flood. If you live in an area where it rains, your house can flood. But we're talking people out of insurance in some cases. You don't need flood insurance. You're not inside that flood map. But if the city and county around you doesn't maintain storm drainage ditches, guess what? That flood map, it changes. Or Walmart gets built down the street. The newly built environment changes that flood map before it can keep up. But yet we still go out and tell people you're in or inside. You're either in or out of a flood map, and it's misleading in many cases.
Marcus, as a technologist, put yourself after an event and just help us think about where technology sits in recovery efforts.
Yeah, I'm turned my head around about that, and I do not want to bash the Munich Re because they are my former employer as well. But they had a nice marketing campaign in Germany a couple of years ago for the first insurer, Ergo, which fits perfectly to what we have heard. And they said, okay, most of you people do not understand what insurance is, and the moment of truth is when the payout comes, you have to send us thousands of papers and fulfill documents, and then you wait 3 months and maybe you get your money or not, is more likely what the people expect. So what I think is, beside private-public partnerships, which I expect as tremendously important, is really that the clients or the policy holders do not have the same understanding of insurance like the risk takers have, which is absolutely normal. So I come back to parametric. Parametric is easy to describe. It can be said, okay, if there's a flood, which happens X, Y, Z, and you can read through that in the newspaper or you see it on television or whatever. This is the trigger number one, which is important. And the second trigger is that you really got affected by the flood, because this is the problem with parametric, which people who don't like it too much argue always about the basis risk, fully understand. But this would make people hopefully aware and understand that insurance is, let's use that word again, not your enemy and more likely your friend, but it should be set up that easy. Think about that. You're really in the middle of a catastrophe. You lost everything, whatever, and then someone asks you to send in papers or for companies to send in documentation, and they say, hey, I'm close to bankrupt. I need the money in whatever, 70, 82 hours in my bank account so I can recover. And this is, from my perspective, very important. I'm not saying that tech is the answer. I'm not even saying that parametric is the answer. But the question is, what do the client really need? And they need money very quickly in their bank account if they are affected by a catastrophe. And then on a second layer, I would say tech can help us out here in making use of this smart contract blockchain payout model linked with a parametric solution, because then there is no way of a discussion. Yeah, it's at the end of the day, it's clearly based on facts from a third independent party. So the payout can be done really easy, and the companies or the people can recover and take care of their life again, and not taking care of making the insurance industry happy and sending in too much of documentation. So this is what I believe.
I think parametrics are a great example of what you were asking me a moment ago about how do state regulators fit into this system. So I think there's a real gap. You've got, and we've heard today about examples of sovereign entities using parametric products. You know, the Mexico coral reef example. There's the consortium of Caribbean nations that use parametric products to recover quickly from hurricane disasters. And then you've got local governments. You've got like the city of New York. You've got the Mississippi River Towns and Cities Initiative that Rugavir was talking about. And you've got a gap of state governments that are sort of bigger than cities, smaller than sovereigns. And state governments aren't doing it. I think you've got a level of sophistication at the sovereign level where they can figure it out and work with institutional players within the insurance system to figure out those types of products. And you've got local units of government who work with trusted community partners to work with people on the ground to figure out what those real risks look like and what the community needs are immediately in the wake that can respond quicker than the indemnity process can resolve a claim. But it's state governments in the middle where there's a lot of opportunity, I think both for the industry, but also for the states themselves, because your mission at the state ultimately is to protect lives, protect the infrastructure. And if you're talking about uninsured losses, that's the metric. Like, we're gonna keep repeating that cycle until we figure out how to get more up to speed on how we can protect our critical infrastructure and ultimately our people at the state level in the US market.
The current disaster declaration model is not going to lead us down to a path of readiness or resilience, period. I mean, if we continue to reward communities for not doing the right things, which is essentially what your disaster declaration process does in this country, we're never going to get ahead. But I will tell you this, with the reform talk, we better be figuring out as a group too how to create alternative funding stream for governors, because it's coming. You know, if you're gonna reduce the footprint of the Federal Emergency Management Agency and turn it back into a disaster relief agency, which I think it should be. It never should have been the world's largest insurer on the planet, which it's become. If you get it back to a disaster relief agency and a community stabilization agency, and the federal government starts pushing block grants down, that coupled with what are the reinsurance avenues for governors that are available, what's the catastrophic bond avenues that are available, what are the parametric insurance things that are there. I think we have to have some conversations with the insurance industry on how we invite the insurance, like what needs to be done from a capital improvement standpoint to get the insurance companies to come in and insure some of this infrastructure that's uninsurable.
And states will never on their own have enough in your disaster recovery account to deal with every major disasters, but it's the small ones, it's the mid-sized ones that accumulate that really eat into your ability to provide services. I was on a plane to the NAIC national meeting in 2013 on August 11th, going to Seattle. And I was watching a hailstorm come in through the airport, and we took off, and it was real unpleasant. And once we leveled off, the pilot came on and said, well, that was fun. And everybody behind us is in a ground stop for hail. That half-hour event through the Twin Cities was a billion-dollar weather event. It was 1.5 hour in August. And that hail event significantly impacted our insurance market. Almost everybody on my parents' block got a new roof. Almost everybody on my boss's block got a new roof. Those mid-size events, which we in Minnesota have had a wildfire event, 2 floods, and a derecho just in the last 12 months. Those are not Hurricane Helene-sized events, but those are all significant disasters for the communities that are affected, and we don't have enough resources over time to handle them all at a state level without figuring out how we can amplify and augment our disaster recovery resources. And the insurance industry is a pathway to figuring out how to do that, because that risk transfer model that you were talking about a moment ago, Rugavir, is a pretty proven method for figuring out how to do that and to increase your capacity to respond quickly to disasters, which is what the people in your state are looking for in those emergency situations.
Can we go ahead and put the QR code up for questions, just in case anybody has a question? Or you can raise your hand and we can take it that way. But give that a try. If anybody has a question, we'll give you a chance to do that, and we'll continue the conversation here. Let's talk about a topic I'm going to call eat your broccoli or you can't leave the table. How do you convince businesses, consumers to do the right thing? What does this panel think about pushing people towards some of those solutions, and particularly some of the engineering that we've heard a little bit about today? But I'm not sure we've kind of cracked the code on getting people to act.
I think we talked a lot about building codes, which I completely agree is a huge important part of that system. We don't do the building code in Minnesota. I think most insurance departments don't. So you've got to figure out how to be a partner with that. Folks in the room might be familiar with Smart Home America, a partner in a lot of states on some of these fortified programs. And Julie Shayu-Woodard was on a panel in California at a conference that I was at in May, and she said something that really struck me hard, which was, if you really want to do this, you should stop talking to people or trying to talk to people, which is contrary to how I think most state departments try to engage with the public, right? You're trying to get the word out, you're trying to communicate, but what she meant was, we're not always going to be the best communicator. Finding trusted partners that you can leverage their existing relationships with communities and leverage what people trust. So as we heard on the stage earlier, looking, when you're going to sell a house or buy a house, often the largest financial transaction that most of us will engage in our life, who are you doing that with? You're doing it with a realtor. You're doing it with an insurance agent. You're doing it with a builder, potentially, with an architect, with an engineer, and it's figuring out how to communicate with those groups so that message is reinforced. I loved what Roy said in the morning panel about how we're not going to win alone by just having incentive programs or a grant program. It has to create an economic environment where what is normally sold to the consumer is something that makes us more resilient as a whole. And that's not a message that we at the State Insurance Department can carry alone. We have to do it with other partners.
I think if I was working for any one of your insurance companies right now, I would be actively writing what the vision of the way forward for a governor looks like. And I'd be getting it's a race down to each one of those 50 governors, and I'd be getting, this is an opportunity with reform. I'm all for holistic reform. I hate the way it's being done right now. I don't agree with the way it's being done. I don't think you just kill FEMA and then hope there's a way forward. You're going to have to time phase implement things in. But I don't think governors and emergency managers and the city county managers know what to ask for. If they put out a request for proposal, to do reinsurance, they wouldn't even know how to write the RFP. So I think that your industry is going to have to start putting this down on paper and putting it forward, to these governors on what to ask for and how to start protecting, controlling their own destiny at the state level.
Just a quick story on the Kerrville floods. There was a lot of talk, locally anyway, near me about the proposal to put flood sirens upstream on the river. This was a very well-known problem. I mean, it was, 100-year plus flood, probably more than that actually, statistically. So they have some excuse, but they knew of the problem. And so I'm not sure how to get people to act ahead of time on things that could be, that impactful on that scale. It's really hard. It's hard to get state and local governments to eat their broccoli too, is what I'm saying. Everybody's the same.
The conversation we were having this morning about wildfire risk, I mean, we're getting there on roofs, as Roy was saying. In order to get people to understand the action that you have to do on wildfire to protect your home, you have to affect the mental picture that you've been drawing in your head of what a house looks like since you were a toddler. Square, triangle on the top, tree outside, plants or flowers in the front of the house. That's how basic the level of communication has to get. And I think that's something that government struggles with. We don't communicate at that kind of level. You've got to find communities trusted community partners to be able to get you into those conversations before you can start to get people to take important action.
We also, we don't learn from disasters a lot of times, particularly like when I look at hurricanes in my life, 26 years of being a part of Katrina or whatever else. Even 20 years after Katrina, we're so focused on what happened in New Orleans. Meanwhile, in Mississippi, 270 people lost their lives due to storm surge with the ocean rise 27 feet. 10,000 families were displaced in Alabama as well. You never hear that story. And one, because there was nobody to interview on what was it like to experience the ocean rising 27 feet. There's no interviews around for that. And so most of what happened in New Orleans doesn't apply to the coast all the way up to Virginia. But that's where the focus is, and that's what people see. They don't realize that the reason we ask you to evacuate is the ocean rising and swallowing you whole, right? It has the highest potential to kill the most amount of people, it causes the most amount of damage. But yet we're not really doing that. We go through what I call hurricane amnesia. I mean, Camille killed 270 people in Mississippi in '69. Katrina did it again, and so we're stuck in this response cycle to where we're not actually taking a breath and understanding what's going on. Hurricane Irma in Florida, we registered more people in Florida into FEMA's individual assistance system than we did in California, Texas, Puerto Rico, and the U.S. Virgin Islands combined. And what we saw were people selling a house up north for a pretty penny, going to buy a house in Florida for cash and not putting insurance on that house because they didn't have to. And they were also talked into buying the homes that were built before the 2001 Florida building codes changed. And then they go through, they lose their home, they bought the wrong home, they had no idea what the real risk from a hurricane was, where they were buying. They paid cash for it, they lost their wealth, and they wanted FEMA to come turn around and make their lives whole again. And so if we don't really understand why we're registering people into individual assistance, then how do we get better?
I'd say, in terms of addressing your question, Craig, there are lots of positive stories out there, and I think we also need to highlight there, because absolutely we need change, but at the same time we also need to acknowledge those positive stories as well. So how many of you have heard about Hurricane Barry? Probably doesn't ring a bell. 2019, it hit New Orleans, and at that same time, the Mississippi was flooding from the north. 2019 was one of the worst flooding of the Mississippi River. But guess what? Those levees and dikes, they held up. That was a great success story, but no one knows. No one remembers that. That actually, risk mitigation helps. Another story, off of the coast of Alabama, a few communities are at risk continuously, so they restored a marshland. And we actually did some analysis for them and found that not only do their homes are protected now, but their insurance could reduce, at least from an expected loss standpoint, by about 15 to 20%. So there are a lot of stories in terms of success stories, but where we also have to address is some of those challenges, like a mayor of Grafton, Illinois, which is the confluence of the Missouri River and the mainstem Mississippi River, did not have, in the same 2019 floods, did not have $25,000 to deploy emergency professionals. So we really have to address that the climate or the extreme weather of the past the future is not the same as the past. So whatever policies we have created, whatever framework we have created, will not work in the future. We have to change that.
I've seen some really amazing engineering videos done by some insurers, like, here's what we did to harden this building against fire, against wind, and part of me just says, why does that not show up on YouTube and get some heavy airtime to get people who are used to consuming information in that way a new view of what happens? Same with the kind of reaction to the hurricanes. I think it's just probably an opportunity that as the generations go, we will have to learn to take advantage of. I think in the time we have left, I have a few questions I want to throw out to the panel. These are from the audience. Let's just throw them out and see who wants to jump on. An elephant in the room is the cost to the environment from using AI. This is kind of the impact on green IT of AI, which I blogged about recently, so I'm glad somebody's asking this question. How do you balance the cost of AI with it being an unavoidable part of our future? Any AI proponents?
Well, I don't know why we're all looking at me for that question.
I don't.
No, you know, in Minnesota, part of our departmental role is to represent the public interest before a Public Utilities Commission. And so I think, you know, this question is, I think, before our commission, as it is in front of many commissions around the country. I think it's a really significant question. I think it is increasingly framed in a cost question. And people are starting to think about it in the same way that they have thought about or not thought about insurance as a pocketbook issue, and it really now is, and it has the potential to have significant impact on residential and commercial rates. So yeah, I don't have an answer, but I would acknowledge that the question is a really big elephant and a significant one to get figured out as quickly as possible.
I think maybe to Raghu's point, this is a new technology that we have not seen before, so it's arriving. We will find a way to use it. What were you going to say?
Yeah, no, I was going to say, and I'll use my own experience, right? If you had asked me 4 or 5 years back, what could nature-based solutions do at the scale of watershed of the Mississippi River, I would probably have no answer. But as of now, we're actually working with the Walton Family Foundation and a conservation company, Ducks Unlimited. What we're trying to figure out is what can we do in terms of quantifying the benefits of all of these nature-based solutions and more in terms of the flood risk reduction over the Mississippi River. Can that be actually thinking, can we have had thought about it like 4 or 5 years back? But with AI, we are actually able to bridge that gap. So there are those pros and cons. I'm not supporting that that it's not having a cost to it, but we really have to come up with a balance of how this, and I know there are corporates who have data centers that are constantly working on replenishing water back to the watershed and so on. So it's a balance that we'll have to get there.
Let's do a few more. Parametric insurance has been spoken of in the state since maybe 2015 or so, and it's interesting, but still hard to buy. Is it ever coming? Yes or no, I guess we're looking for a yes or no. Parametric.
Yes, but with policy change.
Marcus?
It has to, because it's part of the solution we need for the future. Yeah, it must be, there are two opportunities. You have a technology push or a market demand. And we need more likely, we have the market demand and we need to push it from the technology side. Means not AI or blockchain, means the risk takers themselves has to push it into the market and offer this solution to the clients. But the need is there, I would say.
I think, you know, again, I don't consider myself an insurance expert, whether it's parametric insurance or whatever it may be, but when you get to the depressed communities that are struggling to afford insurance and different things, I've often wondered if you could use mitigation dollars. We tend to think of mitigation dollars as being brick and mortar, you know, money, you know, dollars towards that type of thing. But how do you use a FEMA mitigation grant to offset the cost of home ownership or of home insurance, not indefinitely, but maybe on a graduating scale, coupled with the financial, you know, coupled with financial education? Where's the Department of Labor to provide new jobs? You know, to have those conversations. It's got to be more than just a piecemeal solution of here's parametric insurance. There's got to be other things that are strapped onto that, you know, for it to be successful in the future. But I mean, it is a big problem.
And I think the answer is yes. I think it has tremendous potential to augment and amplify our disaster response at the state and local level. I would also be curious to whoever asked that question, who they were thinking of as the purchaser of that product in that question. Because I think the answer is going to be different depending on whether or not you're talking about it for governments, commercial buyers, residential buyers. The pace at which that happens is going to be different.
But I also think, too, getting away from parametric, when it comes back to the insurance and the cost that FEMA has, stop paying for uninsured public infrastructure. If it's insurable, why do we allow cities and communities to not insure their infrastructure and then FEMA rebuilds it for them when it's all knocked out? That crap's got to stop. It's got to be phased out over the next 3 years. And
parametrics could help with that quite a bit. Yep.
Maybe if you hang out over the cocktail hour, you can find out who asked that question, Peter. Couple of questions actually related here. Hurricane Michael House is a building code issue. It was built for the big one. Can insurance companies offer discounts for better insured properties like the house that survived?
Yeah, they definitely can. In Minnesota, in 2023, we required insurance companies to offer a premium discount or a rate reduction for a home that has a fortified roof with hail supplement on it. There was some pushback from the industry about mandates, and we effectively said, well, if you can do it in Alabama, which also mandates it, you can do it in Minnesota. It absolutely can happen, and frankly, a lot of insurance companies were already doing it. What I think is really interesting, where the NAIC has been particularly helpful to us and to our industry, is like, let's think about what that quantifies as. Like, what is the value of that discount to the insurer and to the policyholder? Because one of the other ways you can try to get action from the policyholder is really demonstrate, what is that going to save me? Like, if I spend X amount of dollars to put a stronger roof on my home, what am I going to then on the back end save on my insurance? And that's going to help them make that calculation if you can put it in real dollars and cents. I loved Amy's example of her earthquake policy, not just telling her what the percentage deductible was going to be, but like translating it into a dollar figure. And that dollar figure might be scary, but it actually makes it accessible and understandable to the consumer.
Yeah, I was going to say Alabama's trying to tackle that very problem right there. But for anybody that doesn't understand the house that we're talking about, it was Mexico Beach in Hurricane Michael. And there's a great documentary called Last House Standing. I think it's lasthousestanding.org. If you go there, you can watch about that particular house that's being referenced in the question.
There's some just like that with the California fires too, which I think also have some unique design characteristics that help them survive. Some of it might have been luck too.
Yeah. No, I would say the answer is absolutely yes, right? And if we can quantify the benefits of a levy setback on 1,500 homes in Missouri and showcase 65% decrease in premiums for flood insurance, absolutely we can. The only challenge I want to highlight is, again, the risk mitigation also has to be expanded. It cannot be 10 homes out of 10,000 that are getting mitigated. We can, again, insurance is a portfolio game. So we're coming up with a price based on a portfolio. So the impact of risk mitigation will be even higher if more people adopt that. And that's what the Alabama story is.
Marcus, last word to you.
We're still friends.
Still friends.
Yeah, that's the good news. We are still friends. Last word. Yeah, I see this resilience topic as an overall header. So I'm not saying, as a professor, I give you my takeaway with you. It's not about now implementing AI or thinking about the blockchain again. It's really about the holistic approach, what needs to be done, and then, of course, I would say think about parametric as a potential future opportunity to assist your daily business. And yes, to answer the question, is AI the big elephant in the room? Is it cost extensive? Will it change the world tremendously? The answer is definitely yes. So it's also definitely not a fault to focus on this. Forget about the blockchain. This storyline is over. Don't buy the shitcoins anymore. Focus on AI and download OpenAI to learn how to handle and make the best of the AI experience for yourself.
Well, I have to say I am optimistic about our industry, having listened to the four of you. I think a lot of great ideas kind of packaged up in really interesting ways from the four of you. So perhaps you will all join me in thanking our panel for a great discussion.
Thank you, Craig.
Thank you.
Thank you very much to our panelists. Give me just a second. I just want to sell all those coins I've got real quick. Hang on one sec. Just about to, okay, good. Please help me in welcoming to the stage for some closing remarks the president and CEO of the Metro Hartford Alliance, helping to make today possible, Mr. David Griggs.
Hi, thank you. First off, I just want to thank any board members who are still in the audience today. Thank you for the time and commitment that you give to helping run our initiatives. Thank you to the sponsors for today's event, our partners at CID. Fantastic partnership, and really, when you look at what sets Hartford and our approach to the insurance market apart, it is the partnership that we have with the insurance department. When the private sector and the public sector can get along, go out together, and pitch our community as a place to do business, we really have something special here. So thank you to our partners. To our visitors that are here from South Carolina or Georgia or, God forbid, Kansas City, welcome to the insurance capital. I just want to point out that the insurance capital is more than the geography. The insurance capital is really you, the people that are here in this room. You are what makes Hartford the insurance capital. So thank you for what you do every day, for getting up, going to work, and dealing with some of these issues that we've heard about today. It is your work that is putting Hartford on the map. So thank you. And to the visitors, you are now part of the insurance capital as well. So please come back home as often as you want, as often as you can. Sometimes I like to think about Hartford in the insurance industry, and this is probably dangerous, but it's kind of like the fire, right? This is where the heat is. This is where all the intensity is. And as you go out to the world, to your corners, to preach the insurance industry, to help the insurance industry, sometimes you got to come back close to the fire to keep yourself hot, to keep the embers going. So we invite you to come back every year to this event. We will do this event, and to sit with your counterparts, to learn, to talk, to create the friendships and the camaraderie that you need to make your industry work as well as it does. The Metro Hartford Alliance is many things. It is the IFS. Thank you, Susan Winkler, for the leadership that you have provided it for the many years, and we won't go into how many. But thank you for that leadership. It is through you that we make this possible. We are also the Health Council, and we're talking about health determinants today, which is central to what our Health Council is doing. We are also the Young Professionals Group, the Hartford HYPE, Hartford Young Professionals and Entrepreneurs. For those of you who are running your businesses, please consider having your young people join that. It is our way of trying to get your employees sticky to Hartford, right? For them to find their people, for them to find their home here, so that we can help you keep your talent longer. And finally, we are also the Hartford Chamber of Commerce. So for those of you who are enjoying Pratt Street and the redevelopment of Pratt Street, we're doing that through the Hartford Chamber of Commerce. For those of you with an expense account tonight, on behalf of the Hartford Chamber, go blow it all tonight. Go out, have dinner, have drinks, buy something for your wife or your husband before you go home. Hartford Prince just expanded. It looks fantastic. Please go out, spend your company's money, and come back often. Thank you for coming.
And while you're at it, buy my wife something, please, as well. I've been here all day. Just one quick little housekeeping note: in the event that you happen to be in the same room with him at some point in the future, and you meet or chat with the chair of the CTIFS board or the president of Connecticut, please don't butcher his last name the way that I did. So thank you for your understanding. That's Mark Metter, not Meter. So thank you. I'm the only thing standing between you and the reception. Before I let you go, we have some thank yous to dole out. I want to thank our partners, Event Resources back there, executing an absolutely flawless run of show here with the programming. Really, really smooth. Thank you again to the Marriott Hartford Downtown for their hospitality, and to their team as well for not only welcoming us, but also taking care of us from a service and food and beverage standpoint. I want to thank our sponsors today. Of course, our title sponsor, Cognizant. I want to thank Travelers, Nassau Financial Group, Voya, Infosys, The Hartford, DECD. Thank you very much to RVI Group, Deloitte, and HSB. A round of applause for all of our sponsors. Thank you for your participation. Empower Retirement. I'm sorry, I was trying my best to not look up here. And Empower Retirement. With that being said, thank you all for your participation. I'd be more than happy to come tell a quick joke or two anywhere but Kansas City. I am not going to Kansas City. No Chiefs fans get me. I'm sorry about that. Yeah, sorry, Joe. There you go. Thank you for joining us. A round of applause for yourselves. The bar will be open. Please make sure to stop by and see that wonderful art gallery that we have. We want to thank Susan for bringing those two fabulous artists out here, Abby and Max as well. Let's have a great evening. Enjoy the reception. Thank you for coming.